Hello, everybody. Welcome to this special English power batch for CA Final Direct Taxes and International Taxation. Hope you all are doing really well. Sir, please brief us about this power batch. What is this power batch? How we will be going through? What coverage we will be doing through? How much time we will be taking? Everything I will be sharing detail. You just wait and watch. Sir, this power batch aims to build your concepts if you are lacking in concepts, to build discipline in you if you are not able to focus on studies. This power patch aims for those students only. If you are comfortable in Hindi, you can definitely go for Hindi power batch. Don't subscribe for English power batch. But if you have any doubt कि हिंदी नहीं समझ में आता, then this English power batch is for you. Sir, how long this power batch is going to be? My answer is duration will be 50 hours. I expect nearly 50 hours. Each lecture will be 3.5 hours each. It can be plus minus 5%. That means it can be either 53 hours at most or it can be 47 hours. Sir, 47 hours? Is it possible to complete in 47 hours? Right answer is I have done this. My regular batch was expected, Hindi power batch was expected to be completed in 60 hours, but I was able to complete in just 57 hours. So I am very good at doing things before time. So it is possible that we may be able to complete this in 47 hours also, but I am not committing you. Therefore, I am saying plus minus 5%. So what all books we will be using in this batch? Do tell na. We are very much excited what all books we will be using. See, for this power batch also, I am giving you books of regular batch. The books that we are using for regular batch, I will be sharing in this power batch. Sir, what books do you use in regular batch? First one is concept book. World says is as concept book, but I call it your study mate. I know you are very alone in your journey. You require a partner for your studies, and who else can be a better partner than your book? Therefore, I have crafted this beautiful book of just 300 pages. Beautiful book of 300 pages where every concept has been covered in fine detail. Every word has been thoughtfully written and beautifully given in this book. This book considers your need for study in that last 1.5 day. I know every student faces difficulty in covering DT in last 1.5 day, and this book has been specifically crafted to cater such need only. This book has been specifically crafted to cater such needs, and I am sure that this book will be game changer for all of you. Just give me a second what issue this iPad is doing. Okay, fine. This study mate will be yours. Sir, do we have to buy this study mate or not, or you will be giving it on free? Just for your attempt. Just for your attempt. I have circulated this study mate in Telegram channel. Do join the Telegram channel. You will be getting this book free of cost there only. PDF is already circulated in the channel. Sir, what is which Telegram channel? This is the channel. You can definitely come and visit channel. And StudyMate has already been circulated. And link of this channel will be pinned in the description box. Second book that you will be getting is question answer book. So do we need to buy this? No. Again, this book has been freely circulated in Telegram channel. You can visit Telegram channel and use this book to the fullest. Sir, does this book contain all questions that we are required to solve? Right answer is yes. Every question from StudyMat, every means every. I have not left even a single question, even if it is repeated multiple times. I have covered every question from StudyMat, except for a few questions which were very simple, which were just one liner. I have removed them, but every question from StudyMat has been covered. Sir, not just StudyMat, sir, I have covered every RTP, every question from past RTP which is relevant for today, that has been converted into current finance act. I have given in such question bank. Every past year paper amended as per current finance act is being included in this question bank. And third, the most important thing where you all face difficulty is MCQs. A integrated MCQ compiler where every integrated MCQ which has been given in BOS portal is compiled here. Every single MCQ that is on BOS portal or has been a part of ICA exam pattern is being included in this MCQ booklet. You will be given access to this MCQ booklet also. This will be shared in PDF. This has not been shared yet in Telegram channel, but it will be shared as soon as possible within a day or few. With these all three books now, you don't have to go anywhere else. With these three books, I can assure how much you can target. You can target for at least 70 plus. You can target for 70 plus. I'm saying it seriously. Sir, it is just for we just have 45 days left. Can we really think of 70 plus target? Yes, you can think of if you have prepared well. If you are preparing well along with me, you can definitely target for 70 plus. Because what we will be doing, we will be studying 100% concepts in the class. All you need to do is just revise with me. Just revise after the class for a few minutes and solve question answers. That is your only duty. And sir, for question answers, I have already uploaded a few videos on YouTube channel. Most of the question answers are covered except for few chapters. Until the time this batch will be over, all the chapters will be uploaded. You need not to worry at all for that. So all question answers are also uploaded on YouTube channel. You need not to worry even a bit for that. This batch will be a one-stop solution for your DT preparations. Did you get my point or not? Sir, what else we will be getting with this power batch? Can you tell? Okay. You want extra perks. You are not satisfied with what you are getting. What extra perk you will be getting? First one is I believe in test series. Sir, with 15 days of power batch, we will be given test series. Right answer is test series. No, test. Just a test. One test. One full length test that you will be attempting. And we will be having a different pattern of evaluation in this test. Sir, what can be different? Everyone is doing the same. What can it be different? See, what I have thought is we will be organizing a Zoom session. All the students that those who have enrolled will be completing on the same day. Nearly batch will be over till 30th September. On 1st of October, I want every student who has enrolled to come to Zoom meeting, sit in front of me and write exam for 3 hours. I will be the invigilator and you will be examinees. You will be the one who will be writing paper. I will be the one sitting and invigilating all of you. After that, in that Zoom session only, I will be discussing what right answers are, what mistakes you have done, and where you can correct yourself. This is beautiful thing. Nobody in the industry gives this. I do have this privilege, even by Sarthak sir. I can definitely give you this. So this is really a great benefit that you can get. Second thing, sir, my personal support. Yeah, what else you want? Believe me, I was sitting for May 24 examination. I mean, not for writing, but I was sitting to guide students. I was solving their doubts for May 24 examination, and even a student called me at 1 p.m. on the day of examination. At 2 p.m. it was exam time. 1:30 was the reporting time on the center. I was on call at 1 p.m. We had a conversation for 25 minutes. And just after hanging up the call, he sat for examination and he was the one who secured All India rank 15. Can you believe it? That kind of personal support I give. Even if you have issue in subject, even if you have issue in any other thing, I even call with students. I reply to their queries. Even I study with them. So this is really very, really good thing that you will be getting. I circulate my number publicly. It must be in description also. I will be giving at the last. Those who are sitting till the last will be getting advantage of this number. So stay till last. Third thing, sir, these much benefits with power patch. With just power patch, these much benefits you will be getting. Yes, yes. Third one is my favorite is discipline. I have seen students trying to do first round of revision in DT in 10 days and end up doing in 25 days. This is what you want. You don't have time now. Realize this. You really don't have time. And with this power batch, I am aiming to complete DT in 15 days. This batch will be completely recorded batch. Hopefully, you will be getting 1 or 2 lectures daily. So it might be possible that we'll be ending up this power batch before 15 days. So you have to complete DT along with me. You don't have to wait for other lecture. You already have all the lectures with you. You have to complete DT in 12 days. This is how this batch will help you. This is really a great advantage for at your disposal to complete your first round of revision with ease. Did you get my point? So everything you are giving, there must be something that you want from us. There must be something there must be something you might be wanting from us. Yes, I want a few things from you. So first, sir, fees. Arey Papa, you have already paid the fees. Then only you are getting access for this power batch. Apart from fees, I want a few things from you. First of all, first of all, sir, things I want. Active listening. I really don't want you to sit in this posture or sleep in the class. I want you to sit on a chair of plastic, not the chair having foam on the back. I want you to sit on floor or sit on a stool. I don't want anybody sitting on bed and watching this class. I really want active listening. Whatever word I am using in the class has a deep meaning in it. So active listening is really very important thing. I really want from all of you to cooperate in this segment. Listening is already an integral part of our studies, and sir, active listening is really important for this power patch. If you are not listening, you might affect your topic. You have to again rewind the video and look for it again. Whose time is getting wasted? So this is one thing I really want. I am very serious on this part. I really want active listening. It might be possible. I have explained this topic in 5 years, 5 minutes later, you are thinking, what did he tell? What did he tell? So this is not the case. I will be entertaining. I really want active listening. We will be going fast in this batch. This will not be a regular batch. This will be power batch. Okay. Second thing, sir, I will be giving you homeworks daily. Homework as in, see, you have to solve the question answers. But apart from question answers, I want you all to solve one practice question daily. One practice question that in writing you have to solve. You have to write as if you are writing an exam. I wanted that to be done from your end. This will help you how to write answers. See, I have seen answer sheets of students who have appeared in May 24 attempt. They write nonsense. If they don't know the answer, they write simply nonsense and expect to get marks. You will not be awarded any marks if you don't know how to write answer. So this will definitely help you to the best. See, homework is really important. And question answer solving. in itself is complete homework. So question answers you have to solve by default. But this DPQ, this is the thing that I will be checking every day when when you are given this DPQ or daily practice question to write. You have to send it on my Telegram channel or my Telegram number. I will be correcting or I will be telling you what mistakes you have made. So this homework has to be done. This is the thing I want from you all. Third and the most important thing is trust. So trust. What trust? See, you are watching classes in online mode. You have a privilege to switch to faculty if you don't like the one. If you don't like my videos, you will switch to somebody else. If you don't like his video, you will switch to somebody else. You have this privilege. Use it. I'm not saying stick to one. I'm not saying, but I want you to stick to one for whole subject. If you don't like mine, go for anybody else. If you don't like him, come to me. But if you come to me, you have to have faith in me. It should not be case you are studying one chapter from me, other chapter from other, or third chapter from the third faculty. This should not be case. Because we have a kahavat in Hindi ki dhobi ka kutta na ghar ka na ghat ka. See, if a dog, leave this kahavat. But you have to have faith in the faculty. Believe me or not, the one who is teaching you knows what to be taught, knows how to be taught, and there won't be a single concept that you will be finding in any other faculty not covered in our book. This book has been beautifully crafted and proofread many times. There might be still many issues in this book. A few grammatical errors, few numbering errors, page numbers have been not numbered well. There might be a issue, there might be a few issues, but trust factor has to be there. If you have any issue, communicate to me. I will be there to answer you. So you haven't told your number, how will we communicate you? Arey Papa. This is my personal number. You can call me. See, this is the mobile phone I'm having. I don't have any iPhone. This is single mobile I'm having. I'm having the same number in my phone. This is my personal number. I don't delegate doubts to anybody else. Second thing, whenever you're calling me, make sure that you are calling it on right time. रात के 2 बजे कॉल नहीं करना. See, you don't have to call it at 2 p.m. at night. ठीक है? You have to be time cautious at what time you are calling, what I must be doing at that time, and there might be possibility I may not pick up the call at that moment. But it is for sure that I'll be giving you a call back. So you can call me even, but I will be giving you a call back if I don't pick up the call. So this is my number. If you have any doubt in curriculum, if you have any doubt in subject, if you have any doubt in topic, if you have any doubt other than DT, I will be answering. So, sir, this was all about details of this power batch. Let us firstly understand the topic, understand the curriculum first, and then we can proceed with the chapters. First of all, exam pattern. Let us understand, sir, exam pattern. So, which paper number we are studying here? So, paper number 4. What is the name of the chapter? What is the name of the paper? Okay. Direct tax laws and international taxation is the name of the chapter, name of the paper. If you carefully examine paper has two parts. First one is MCQs and the second part is subjective, or I should say descriptive portion. MCQ we have for 30 marks, out of which first and second question are of 5. First question is of, wait a second. First question 4 marks, second question 5 marks, and balance 1 or 2 mark each. These first two questions are integrated MCQs. Like these can be from multiple chapters. This will be a paragraph given to you, and based on that paragraph, you can be asked many questions from that paragraph. And that paragraph can comprise multiple chapters. These will be integrated MCQs, and other will be normal MCQs. Subjective portion, you have 6 questions of 14 marks each, out of which first one is compulsory. First question is compulsory, and first question is from total income. This question only comprises calculation of total income for a company, not even individual. You will be studying for company only. First question is always from total income calculation for company only, or I should say it will be from PGBP, not just total income, but PGBP, profit and gain from business and corporation. From second to sixth, out of five, attempt any four. This will make up your 70 marks. Did you get this point? What my aim is, just hear to this. What my aim is, how you are gonna get 70 marks. So first of all, this has to be tackled beautifully. At least 25, 22 to 25 marks. And balance out of 70, I want 40, 45 marks. This is how I am targeting 70 marks. Is it achievable, sir? Yes, it is achievable. I don't know how many students have achieved 70 in this May 24 attempt. So it is definitely achievable. This was your exam pattern. Apart from that, there are a few things to be told. In this subjective portion, in the subjective portion, question number 5, A is case law based question. I will be telling you how questions come in this part, but later on, not now. Question number 6, A, B, C are theory based questions, like from international taxation or any other smaller chapter comprising just theory. This question will not involve any practical portion. This will be just theory question. Sometimes you can avoid this question, but many a times when practical is tough, this question turns out to be a game changer for you all. So our batch will not be differentiating in any terms whether you have to study theory or leave theory. We will be covering everything in this class. So this was a basic idea about the exam pattern. Did you get this point or not? Did you understand what exam pattern is? How paper is being asked in this? How paper is being asked in exams? I hope things must be very clear. Now, few basics. Few basics that you need to know before starting. A few basics you all need to know before starting this curriculum. First of all is, sir, what are taxes? So do we really need to know what are taxes? Not necessary. You will not be asked what are taxes in CE final. I'm just telling you because this forms part of your basics chapter. So I'm just telling you. What are taxes? Nothing but unilateral finance charge. Nothing. Taxes are nothing but unilateral finance charges. Sir, simply you have to give to government and you will not be getting anything in return. What happens, sir, when your sister gives you money, your sister lends you some money just to spend it somewhere? Does she expect anything in return? No. When your parents give you any money, does they expect anything in return? Of course, you can return something by gifting them any gifting, or you can use such money to develop yourself and gift your parents. This is the basic expectation your parents have. But do they have direct expectation of any return? No, they don't have. So like your parents don't expect anything by giving money to you. Similarly, you don't expect anything by giving taxes to the government, and there will be development, there will be roads, there will be water, there will be many things, schools, hospital, but you cannot expect anything in return. You cannot expect anything in directly in return from the government. That is why we call it taxes. This is the basic thing that you need to know. Second thing, what is previous year? Previous year is nothing but sir, previous year is the year in which income is earned. For the period that I will be earning income is called previous year. For your attempt, which previous year is applicable? Previous year 23, 24. Right away, starting from income, 1st April 2023 to 31st March 2024, which means any income earned during this period will be taxed in the next year, and you have to study how it will be taxed. Your whole curriculum revolves around how income will be taxed that is earned in this period. Sir, is there any possibility that this previous year may be lesser than a year? Is there any possibility that this previous year may be lesser than this period? For example, I don't have any business. I don't have any business. So I don't have any income. I started business in December. So can my previous year be shorter than complete financial year? Right answer is yes, your previous year can be shorter than a complete financial year. Sir, it can be. Previous year can be a full financial year or a period shorter than financial year from date of commencement of business. So which means if I am commencing business from 1st December 2023 and sir ending on 31st March 2024, will my previous year be shorter than 1 year? Yes. And I really want you to remember this thing. Why, sir? Why you want us to remember this thing? Because when I will be teaching you trust taxation, I will be referring you this thing, and at that time you will not remember anything. So I want you all to remember this part, that previous year can be shorter than a complete financial year. What is previous year? What is previous year? Year in which income is earned. Any income which is earned in this financial year will be taxed in next year, and how it will be taxed you will be studying in this curriculum. So previous year is the year in which income is earned, and for your examination, November 24 examination, previous year 23, 24 is applicable. Third thing, what is assessment year? To call in layman term, year in which income is taxed. Simple. As simple as it can be. Income in which year is income is earned. Year in which income is earned is nothing but previous year. So we have to tax it somewhere now. So we will be taxing it in next year, which is assessment year. Normally, you earn income in this period and pay taxes on 31st July, 31st July of the next year. So this 31st July period is fine, nothing but assessment year. That is we call assessment year. Year in which income is taxed is nothing but assessment year. Is there any chance that tax can be paid in previous year only, or income can be taxed in previous year only? Is there any chance that income can be taxed in previous year only? Right answer is yes. There are 5 cases. There are 5 cases in which income can be taxed in previous year only. That means as soon as you earn the income, government wants tax, tax, tax. Government wants tax. Government will not wait for year to end and assessment year to come to. So there are 5. Previous year is equal to assessment year, which means the year in which income is earned and the year in which income is taxed becomes same, which means income earned in previous year will be taxed in previous year itself. What are those five cases? Let us understand. So, how long can an assessment year go? You all must have studied in detail. I'm presuming you know something. You are not sitting here for the first time. You know something. Assessment year can be as good as for 1 year. Can it be shorter than 1 year like previous year? Like previous year can be shorter than a financial year. Can assessment year be shorter than a financial year? Right answer is no. It is a complete year. See, income earning period can be lesser than financial year, but taxing period will be for complete 1 year. This is the basic that you already know. I'm just revisiting that point. So, what I was saying, cases where income is taxed in previous year itself. First one is Indian leaving India without intention of coming back. If somebody is leaving India without any intention of coming back, what government will do? It will wait for next year to come and tax such person. Right answer is no, it will tax in previous year itself. So what does this means without intention of coming back? Sir, it means if person is going after marriage. Or like Vijay Mallya is flying away from India, so government will be asking for taxes in previous year itself. Government will not wait for year to end and let July come or let September come and ask for taxes. Right answer is government will tax such person in previous year itself. Second thing, sir, if a AOP or a trust is created for a specific purpose and such purpose is fulfilled, for example, I created a trust. I want to feed 5 lakh people. भंडारा करवाना है ठीक है I wanted to feed 5 lakh people. That is what my intention is. I created a trust. I seek donation from different donors for such langar, for such bhandara. I seek donation from everybody. I am earning something. I have created this AOP or I have created this trust for feeding people, for feeding 5 lakh people. Once my target is fulfilled, once my purpose is fulfilled, and government will be asking tax in that previous year only. If a trust or AOP is created for a specific purpose and such purpose is fulfilled, government can tax such AOP in previous year itself. Because what may happen to different people, they may go anywhere, you don't know. And trust and AOP are sensitive matters. So government want to tax in previous year itself only, they can tax in previous year. Third thing, discontinued business. What if I start a business and end in previous year itself only? I start a business and end in previous year only. Government, if government wants, they can tax me in previous year only. Fourth, non-resident foreign company having shipping business. Are Baba, just tell me if a ship comes to India, it earns something from India. Now, if government will wait for next year to come and tax such ship, what how will it receive tax? That one ship once gone will never come to India, will never pay taxes. So as soon as ship leaves India, it has to pay the required tax. So government is taxing in previous year itself. And there is one point. Let's refer a book for that. Yes. Last point is person selling assets to defraud revenue. Some Somehow government noticed that Rahul has bungalow in Juhu, Mumbai. Government noticed that Rahul has bungalow, and what I tried to do, if government want to tax me, they can tax me next year. What I did, I just sold that house. Just with an intention to defraud the revenue authorities, I sold that house in previous year itself. Can government, does government has to wait? Does it has to wait for next year to come? Right answer is government can tax in previous year only if it is of the opinion that there is a fraud in revenue, or there is a kind of fraud being done with the revenue authorities. Government can tax such individual in previous year also. Did you get this or not? The next thing, let's come to next point. What is person? What is person, sir? Person has different meaning. Person can be individual, like a man, woman. Person can be HUF. Person can be AOP. AOP means association of person, a group of people coming together for a common purpose, like we have trade associations. We have BOIs, we have companies. It can be either Indian companies, domestic companies, or you can call them, they can be foreign companies. We can have artificial juridical person. What are artificial juridical person? They are nothing but sir, for example, trusts, political parties, or you can say courts, temples. These can be artificial juridical person. What else can be people? What else can be people? So yes, partnership. Partnership. I did miss out. Local authority. Local authority is also people. Firm, LLP, LLP. They are also people. They are also person. And local authority, like Gram Panchayat, or we have municipality. These are also person. These are the person. Whenever you see if any person escapes any income, or you'll see person used many a times. Wherever the person word is used, they are referring to different type of people, different type of assessees, different type of category of persons. And what does assessee means? Does they mean the same? Right answer is there is a difference. Person means people out of this category. But if such person are liable to pay tax, now they are called assessee. Normally, we call them person. If I call person, it means individual, HUF, AOP, BOI, artificial juridical person, company, a partnership firm, local authority. Normally, person mean this. But if such person is liable to pay tax, if such person is liable to pay tax, then it is called SSC. Then it is called SSC. Person liable to pay tax is called SSC. Did you get this point or not? Yes, sir, we got this. Just come to book with me. Let's see till now, whatever we have studied, does it match with the curriculum or not? Taxes means unilateral finance charge in the form of unilateral payment in the form of compulsory finance charge given to government. And direct tax means taxes on the income. Direct tax. Do you need to really study what direct tax means in CFI? No. So constitutional right to tax. Sir, how in constitution? How government can tax you? Does it have any right to tax? Right answer is constitution permits government to tax individuals. As per union list, if you remember, we have three lists in constitution. Union list, which deals with the matter that central government can deal with, or a state list, which matters only state government can deal with, and we have a concurrent list in which matters, sir, commonly will be discussed. For example, education and health. So union list, the matters on which central government can deal with, prescribes under section under entry 82 that income on tax on income will be charged when government wants. When central government decides, and whatever amount central government decides, it can tax such income, it can tax any income. But sir, power for taxing agriculture income has been bestowed to state government only. No central government can tax any agriculture income. That is why we don't have any agriculture income tax. Every person earning agriculture income doesn't pay any taxes, except for a few cases where partial integration is levied. But person having agriculture income does not pay any tax. Simple reason is central government cannot levy any tax on agriculture income. Rather, state government can levy. Sir, do we have any agriculture tax on agriculture income? Right answer is no. Government will fall in that case. Sources of direct tax laws, very simple, sir. There is difference between law and tax. Law and act. See, law is a broader term. Act is a smaller term. Act is the one that has been approved in approved in cabinet, approved in parliament, which has been approved in Lok Sabha and Rajya Sabha, and with the assent of the president, it has been enacted. That is the act. But in time to times, governments wants to amend such acts. How can it do so? Again, it has to go through the lengthy procedure of getting approval from houses of the parliament. So in that case, government introduces rules. Like for valuation rules, we have rates of depreciation, they are prescribed in rules. So if they want to change a few things in the act, they prescribe in rule. Apart from that, we have annual finance act. Every year, finance minister comes with a finance act, announces, मैं निर्मला सीतारमण आज इस चीज पे टैक्स करने वाली हूँ. She wants to tax everything. Every year she comes and announces a finance act. That finance act is also a source of direct tax. For your attempt, which finance act is applicable? Finance Act 2023. Finance Act 2023. Along with that, there are many circulars which are binding, circulars issued by CBDT. Sir, what is CBDT? CBDT is nothing but Central Board of Direct Taxes. Board constituted under Ministry of Finance, regulating the activities related to direct taxation. From time to time, CBDT issues certain circulars for all the burning topics in the industry. CBDT issues circular to tell AOs, to tell assessing officer how to deal with such things, to tell SSC how to treat such matters when they face in real life. So CBT circulars are also relevant for understanding direct tax laws. Time to time, CBDT issues notifications. So, for example, we are sitting in office on 31st July, and you receive a notification that date has been extended. Who has power to extend such dates? Right answer is CBDT has such powers, and such notifications are also source of income tax laws. And last but not the least, judgments given by various appellate authorities like Supreme Court, like High Court, like ITAT. These judgments also form part of your direct tax laws. And for that matter, you need to study only Supreme Court judgments and High Court judgments. There are no ITAT judgments in your syllabus. You need not to study any such. Did you get that? Yes, sir. We did understand what you are trying to say. So what does person means? Individual, like a man, woman, HUF, partnership firm, LLP. A company, it can be either Indian company or foreign company. Association of person, local authority, like municipality, gram panchayat. Or artificial juridical person like courts, temples, political parties, or any trusts which are registered. These are nothing but artificial juridical person. Sir, what does assessee means? Assessee means nothing but every person, sir, who is liable to pay tax or any sum under Income Tax Act 1961. So, for example, you are not liable to pay tax, you are liable to pay penalty under Income Tax Act. Whether you will be assessee, right answer is you will be assessee. Or any proceedings have been initiated, or he has been He has been termed as SSC in default. In that case also he will be termed as SSC. Assessment year, first of all, understand previous year. Year in which income is earned. Year in which income is earned is nothing but previous year. Starts from 1st April till 31st March. But in case of a newly established business, previous year can start from the date from which business has been commenced. And assessment year is nothing but year of tax payment starting from 1st April till 31st March of the previous year. Right as soon as previous year ends on 31st March, from the next day assessment year starts and ends on next to 31st March. That is the assessment year in which income is taxed. Certain cases where income is taxed in previous year itself, like shipping business of a non-resident person. Income of person leaving for long duration without intention of returning. For example, marriage. I am leaving India for marriage. What if I tell you I'm leaving India? I'm leaving India for education. Does that mean that I'm leaving India without any intention of coming back? I'm waiting for your answer. Did you understand my question? If I am leaving India with an intention to study abroad, does that mean I don't have any intention of coming back? Does that mean I don't have any intention of coming back? Right answer is going for education means you will be coming back. Going for education outside means you have an intention of coming back. But if you go out for a marriage, if you go out in marriage, there is no intention of coming back. Once you are gone forever. So in that case, your income will be taxed in previous year itself. If a AOP, BOI, artificial juridical person form for a particular purpose and that purpose is fulfilled, then income can be taxed in previous year only. Person trying to escape income by transferring assets, okay, or income from discontinued business. So this was all about your basics that you need to understand before starting this curriculum. There are two more important concepts I need to tell you. First of all, we need to understand how to calculate total income. This is the standard format. You have to use this format everywhere you are solving total income. First of all, sir, income from salary, you have to write previous year for which you are calculating, and beside that, you have to write assessment year. Particulars, not necessary, but income from salary, if any, income from house property, if any, income from business profession, income from capital gain, income from other sources. Then we have clubbing of income, like if we have any minor income that has to be clubbed in you, or income of your spouse, which is to be clubbed as per clubbing provisions. We'll be adding here, or any set off or carry forward of any losses. Like we have any past year losses that has to be set off here. It can be set off here. With that, we will be getting gross total income. From that gross total income, we have to reduce deductions under Chapter 6A, like we have 80C, 80D. All such deductions are to be reduced before gross total income. With that, we will get net total income, or many a times referred as total income. In real life, we use word total income, but in your syllabus, we use net total income. After getting net total income, we get net total income. We have to calculate taxes on that income. What taxes are to be payable is calculated on net total income. We have to add surcharge, whatever the case may be. We'll be studying how surcharge, what surcharge, how surcharge is. And we have to add education cess, 4% of education cess and 4% education cess plus surcharge. Like for example, we have tax of 1 crore rupees, 100 lakhs rupees tax we have. We have surcharge of 10%, that is 10 lakh rupees. So we have tax plus surcharge is 110 lakh rupees. Now 4% education cess will be added on what? Sir, either on 100 lakh or 110 lakh. Right answer is 4% of education cess will be added on tax plus surcharge amount. Tax plus surcharge amount we will be taxed on tax. Ultimately, there is compounding of tax. Did you understand? We are being taxed again. Surcharge means tax pay tax. Surcharge means tax pay tax, and 4% education means you are being charged 4% of this actual tax and 4% of this surcharge also. So ultimately, you are again taxed on surcharge. So this 4% education cess is to be added, which leads to you total tax liability. Now, if you have any TDS thesis credit, which it will be reduced. If you have any advanced tax paid, it will be reduced. Or if you have any relief under section 8990, it will be reduced. We will be getting net tax payable or refundable. This has to be rounded in nearest 10. Nearest 10 rounding has to be made. Otherwise, many a times you will not get correct answer. Okay. This was all about your basics. Just tell me how it all went through. Did you understand what I was trying to say? Did you really understand what I was trying to say? Yes, sir, we did understand. If you really have doubt till now, you can you can telegram me, you can WhatsApp me. I don't think there will be any issue till now. But major portion is about to come, yet to come. There are bigger chapters which will be requiring greater focus. These all things you already know. You don't need to focus even for this. And even last a day before exam, you need not to even refer such topics. But because it is our first day, we have to carefully go through how you know, what you don't know, how we have to proceed. I have to take care of those things. So we are going slow. Otherwise, this would have been a part of 10 minutes topic. We have unnecessarily dragged for 30 minutes. Okay, is that clear? Let's approach to next topic, that is general tax rates. Sir, what is tax rate? What is general tax rates for assessment year 24-25? For before understanding what is general tax rate, let's come to board notes. You need not to write this. I'll be sharing this PDF with you all. Need not to worry. Tax rates. Income tax prescribes two types of rates: general tax rates or alternate tax rates. Alternatively, we have special tax rates. You are already aware that income earned under section 112A listed securities, long-term income are taxed at 10% over and above of 1 lakh. You are already aware that income from long-term capital gain under section 112 are taxed at 112 is taxed at 20%. Income under section 111A is taxed at 15%, or income under section 112A is taxed at 10% over and above 1 lakh. You are already aware of these things. These are special tax rates. These are these are not normal tax rates. These taxes are imposed on specified income. But what if person earns general income? So for that we have general tax rates. General tax rates has been classified into two cases, that is general tax rates and we have alternate tax regime. These were prescribed from millions of years back. Alternate tax regimes are newly introduced. A few years back, government introduced alternate tax regime. Like individual or other SSCs have option to opt for either general tax rates or alternate tax rates. What is this general tax rate? Let us understand in detail. First of all, if any individual, sir, any individual, HUF, AOP, BOI, artificial juridical person, any individual, HUF, AOP, BOI, artificial juridical person, whether resident or non-resident, not relevant. Whether resident or non-resident, not relevant. If his net total income or total income, sir, exceeds basic exemption limit, sir, his income is liable to be taxed. What is the tax rate? Sir, government says up to 2,50,000, which is the basic exemption limit, no tax is imposed. No tax is charged. From 2,50,000 to 5 lakh, 5% will be taxed. Sir, from 5 lakh up to 10 lakh, so 20% will be taxed. And above 10 lakh, we have 30% rate. Sir, this tax structure is in slab form. It is not like if we have 10 lakh income, our whole income will be taxed at 30%. No. Up to 2 lakh 50, we will be paying no tax. From 2,50,000 till 5 lakh, we'll be charged 5%. From 5 lakh to 10 lakh, we'll be charged 20%. And above 10 lakh, we'll be charged 30%. This is the slab. Like, for example, if you have income of 12 lakh rupees, your first 2.5 lakh rupees are exempt. 2.5 lakh to 5 lakh, we'll be charged at the rate 5%, which will be nearly 12,500. From 5 lakh till 10 lakh, we have 20%, which will be equal to 1 lakh. And 10 lakh to 12 lakh, we have 2 2 lakh income, it will be charged 30% will be 60,000. So all in all, our tax liability will be 1,72,500. This will be the case of solving. This is how we have to solve. This is not just tax rate, this is slab rate. Then we do have concessions for senior citizens. If a person who is 60 years of age, if a person who is 60 years of age, then we have a slight change in tax rate. What is slight change? Government says, if his total income is up to 3 lakh rupees, he is not required to pay any taxes. Earlier we had this 2.5 lakh, but this has been increased to 3 lakh in case of senior citizen. And from 3 lakh to 5 lakh, from 3 lakh to 5 lakh, we have 5% tax rates. From 5 lakh to 10 lakh, we have 20%, and above 10 lakh, we have 30% tax rate. Complete slab is same. Difference is created at just basic exemption limit. Here we have 2.5 lakh as basic exemption limit. Here we have 3 lakh basic exemption. Like we have, which means you don't have to pay tax till 3 lakh rupees. Earlier we had basic exemption limit of 2.5 lakh, which means we were not required to pay tax till 2.5 lakh. Two more important things that you need to understand before skipping to next topic. This provision is only applicable for resident senior citizen. If a senior citizen is resident, then only he gets benefit of this increased basic exemption limit. Otherwise, he'll fall in this category only. Like if we have a senior citizen who is non-resident, who is of age of 65 and non-resident, he will be still charged this slab rate and not this one. This is important thing that you need to understand. Second thing that you need to understand, what if a person has birthday? Just come to board notes. Mr. Rahul completes क्या? Born on 1st April 2000, 2000 no, 1964. 60 years completed on 1st April 2024. Rahul was born on 1st April 1964. He celebrated his 60th birthday on. He completed 60 years of age on 1st April 2024. Will he be eligible for that concessional tax rate? Or will he be eligible for that increased basic exemption limit? What is your take on this? Right answer is, if he's celebrating birthday on 1st April now, it is assumed that he has completed 60 years of age a day before. That means he has achieved 60 years of age on 31st March, which means on 31st March he was 60, and hence he will be eligible for this increased 3 lakh basic exemption limit. Did you get this point or not? Did you get this point or not? This point simply says that if a person has birthday on 1st April 2024, completes age of 60 on 1st April, he is deemed to have completed such age a day before, which means on 31st March only he will be considered a person of 60 years of age. Did you get this point or not? Yes, sir, we did get your point. We did get your point. Next thing. If a super senior citizen, like a person who is of 80 years of age. Earlier we had a normal person up to 2.5 lakh no tax. Here we have a resident person of age 60 or more, up to 3 lakh no tax. Here we have a person of 80 years of age who is resident, up to 5 lakh no tax, 5 lakh to 10 lakh 20%, and 10 lakh greater than 10 lakh 30%. Simple, just basic exemption limit is being increased for such individual. There is no additional benefit given to them. But one thing to be taken care of is he has to be resident. This benefit is not available for non-resident. This is only available for resident person. Did you get this point or not? Yes, sir. We did understand what you are trying to say. This benefit is given for resident only. Now we have common points that need to be taken care of. What common points, sir? So surcharge for an individual HUF, AOP, BI, artificial juridical person. Government wants to tax such income again. Whatever tax payable has been calculated till now based on above income, you have to add surcharge to such income. What is the surcharge rate? So surcharge rate is if income is up to 50 lakh rupees, nil surcharge. But if income is more than 50 lakh, but up to 1 crore rupees, the surcharge rate is 10%. Here we are talking about total income, not the tax liability. Total income is greater than 50 lakh, whatever tax calculated, add 10% surcharge to it. If income is between 1 crore to 2 crore, add 15% surcharge. But sir, if income is more than 2 crore, up to 5 crore, sir, surcharge will be different. How surcharge will be calculated? Focus on me, what I am trying to say. Government says we have specially taxed income like dividend, LTCG, LTCG 112. These are specially taxed income. These incomes are taxed on special rates. We cannot charge too much surcharge on these incomes. So sir, the government said only 15% surcharge will be levied on these incomes irrespective of the total income. If you earn 10 crore, these incomes will be surcharged at 15% only. If you earn 200 crore, these incomes will be surcharged. These in surcharge on these income will be 15% only. Which means this leads you to a point where you have to bifurcate the income. If your income exceeds 2 crore, what government says? Bifurcate the income. Government says if you have dividend LTCG 112 STCG, it will be surcharged at 15% only. But you have to see what is the value of the other income. Remove the specially taxed income. Check what is the total of the other income. If the total of the other income is up to 2 crore rupees, add 15% surcharge to it. What if other income is more than 2 crore but up to 5 crore? What will be the surcharge rate? 25% surcharge will be charged. And if other income is more than 5 crore, add 37% surcharge to it. Which means once total income of 2 crore is crossed, remove dividend, LTCG, STCG, and specially taxed income. All in all the specially taxed income you have to remove and check whether it exceeds 2 crore or 5 crore limit. So what I said, surcharge, what is the surcharge rate? Up to 50 lakh, no surcharge. If total income is greater than 50 lakh rupees but lesser than 1 crore, 10% surcharge is to be added. If total income is greater than 1 crore but not more than 2 crore, 15% surcharge is to be added. Then if income is greater than 2 crore to 5 crore, 25% surcharge, but only on other income, not on specially tax income. And if income is more than 5 crore, then we have to add 37% surcharge only on other income and not on the dividend income or specially tax income. How we have to bifurcate? We have to bifurcate in two forms. First of all, we will find out what the total income is. We have to find out what total income is, and we have to segregate the income which is specially taxed. After segregating, we have to check whether the other income is below 2 lakhs, should be below 2 CR. If it is below 2 CR, we'll add 15% surcharge to it. If such income, asif, if such other income is more than 2 crore but lesser than 5 crore, we'll get 25% surcharge. And if such income is more than 5 crore, we'll add 37% surcharge to it. Did you get this point or not? Let us see an example which will definitely clarify your doubt. For example, by God's grace, by the grace of Almighty, I have such income. I have such income. Let's see how such incomes are taxed. Let's see. Wait for a second. Okay. I have tried to hide the answers. Let's see what your solution has turned out to be. How much you have understood till now, we'll understand with your answers. Capital gain dividend income is 15 lakh and other income is 25 lakh rupees, which implies total income is 40 lakh. Total income is 40 lakh. Do we have any surcharge on total income lesser than 50 lakh rupees? Right answer is no. No surcharge, no surcharge. If total income is up to 50 lakh, we don't add any surcharge. Specially taxed income 45 lakh, other income 50 lakh rupees, total income 95 lakh rupees. So total income if greater than 50 lakh, lesser than 1 crore, what surcharge rate we have to add, sir? We have to add 10% surcharge to both the incomes. There is no doubt to it. If total income, sir, up to 2 crore, now there is no demarcation of specially taxed income. But if total income exceeds 2 crore, then we have to separate it. Let's see. Capital gain, specially tax income, 55 lakh. Sir, other income, 65 lakh. Total 1.2 CR. Sir, we have income greater than 1 crore but lesser than 2 crore. So, surcharge will be applicable at 15% in both the cases. No doubt, there is no doubt, sir, surcharge will be 15% in both the cases. Okay, simple, simple. Specially taxed income is 2.3 CR and other income is 25 lakh rupees. Sir, total income 2.55. What conclusion can you draw? Sir, total income is more than 2 crore. So we have to bifurcate the other income. Sir, we have to bifurcate the other specially taxed income. So specially taxed income is 2.3 CR and we have studied that specially taxed income will be surcharged at 15% only. We have to see the other income. If other income is up to 2 crore, there will be 15% surcharge. So other income is up to 2 crore. Yes, so 15% surcharge will be applicable. Specially taxed income is 1 crore and other income is 2.6 crore. Total income is 3.6 crore. Income greater than 2 crore, we have to bifurcate. Specially tax income will be surcharged at 15%. But other income, if greater than 2 crore, what surcharge will be added? Sir, if income is greater than 2 crore but up to 5 crore, surcharge will be added at the rate 25%. This is what we have studied. See, this is what we have added. Other income greater than 2 crore but up to 5 crore. Other income greater than 2 crore but up to 5 crore. 25% surcharge. Specially tax income, 4 crore. Wow. Other income, 3 CR. Total income, 7 CR. So if income is more than 2 crore, we have to segregate. Specially tax income will be surcharged at 15%. We have to see other income. If other income is more than 2 crore but lesser than 5 crore, 25% surcharge, we have to add 25% surcharge, nothing else. Let's see next point. Sir, 4 CR is specially tax income, 6 CR is other income, total income is 10 CR. Again, income is more than 2 CR. So in that case, just specially tax income will be surcharged at 15%. We have to see the other income. If other income is more than 2 CR, then 25%. If other income is more than 5 CR, then 37% surcharge will be applicable. So in that case, 37% surcharge will be applicable here. And the last but not the least, simple question. 10 CR, 10 CR, total income is 20 CR. Simply special rate income, specially tax income will be surcharged at 15%. And other income, if greater than 5 crore, then 37% surcharge will be applicable. Let's see what answers we have. Correct, 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 correct. Oh, what is this? Correct, 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 correct. Oh, yes, I wrote 35%, it is 37%. See, this is how concepts are taught in this class. Not wasting time, let us understand the tax rates of other entities. Sir, if a local authority earns any income, or any partnership firm earns any income, or any LLP earns any income, his income will be taxed flat 30%. There is no chance that his income will be taxed at any percent lesser than that. Flat 30%. Even if it earns 1 rupee, his income will be taxable. Its income will be taxable with 30%. And if total income increases, if total income exceeds 1 CR, so in that case, 12% surcharge will be applicable. I want you to draw a skull here. I want you to draw a skull here because you are bound to forget this. You are bound to forget this because what is the tax rate of local authority? You will forget if I ask you after 4 days. So you are requested to draw a skull here so that you do not forget what the tax rate for local authority is. So, company, tax rate for the company. Things to be remembered. Things are to be remembered here. For domestic company, which is having turnover of 400 crore in previous year 21-22, we'll be having surcharge limit or tax rate of 25%. But if a domestic company who is having turnover greater than 400 crore, sir, it will be taxed at 30%. What if, sir, company has turnover zero? Company has not even commenced its business in previous year 21-22. Right answer is it will be assumed that it has turnover zero. It will still be taxed at 25%. And sir, last but not the least, foreign company taxed at 40%. Sir, why the state is given? We are not able to understand why the state is given. I'll tell you why. I'll tell you why. So how many of you can tell on which date Finance Act 2023? Of course, you are studying Finance Act 2023. On what date Finance Act 2023 was proposed in Parliament by Nirmala Sitharaman, by our finance minister? On what date it was proposed in the Parliament? So if you remember, 1st February 2023 is the date in which Finance Act 2023 was proposed. The draft bill was proposed. So it was enacted from 1st April 2023 to 31st March 2024. Correct. This is the case. But it was proposed in this case. Now you all want from me that she should have said previous year 22-23 and not previous year 22-20 or previous year 21-22. You all want me to write this. You all want me to write this. What if she would have written this previous year? What if she would have written previous year 2023? Just imagine for a second. If finance minister would have written previous year 22-23, turnover of previous year 22-23 should be up to 400 crore. What companies would have done? What companies would have done? They still would have had 2 months left to manipulate their turnover. Can you see this? Previous year 22-23 turnover has to be 400 crore. People still had 2 months to manipulate their turnover and reduce before 400 CR. So for that matter, a previous year which has been completed is being checked to check whether for 25% tax limit is applicable or not. Did you get this point or not? Did you get this point or not? See, on the date of announcing this bill, she wants you all to check whether in the previous year which is completed, your turnover exceeds 400 crore or not. If your turnover exceeds 400 crore, then in that case, your income will be taxed at 30%. If does not exceeds 400 crore, your income will be taxed at 25%. And foreign companies, it is simple 40%. So one disclaimer I want to give you all. Do you remember the halla noise? Do you hear noise around you? Yes, sir, we do hear noise around us. Not that noise, Babu, not that noise. You must have heard there are many changes in Finance Act 2024. There are many changes in Finance Act 2024, like rates of capital gain has changed, indexation has been scrapped. You must have heard many noise around you. Believe me or not even a single thing is applicable for your attempt. Finance Act 2023 means Finance Act 2023 and it does not imply 2024. So any amendment that is proposed or enacted as per Finance Act 2024, whether it was given in February or the Finance Act which was given by Finance Minister on July, it should bother nothing to you because it is irrelevant for you. Only Finance Act 2023 is applicable. What we are studying is as per Finance Act 2023. You need not to see anything else. Then, so this was the tax rate of the company. Now we have to add surcharge to the company. See how government can leave you without surcharge. If your income is more than specified limit, your tax will be added. Your tax will be increased. What it says, if your total income is if your total income is greater than 1 crore, but up to 10 CR. If your total income is up to greater than 1 CR but lesser than 10 CR, sir, for domestic company 7% surcharge is to be added, and sir, foreign company 2% surcharge is to be added. And for total income exceeding 10 CR, but for domestic company 12% surcharge is to be added and 5% for foreign company. Did you get this point or not? You have to remember this because you are bound to forget this. You will definitely forget surcharge if you are calculating total income. See what I said initially, you will be seeing question from total income only, and total income that too of company. So for that matter, you need to remember tax rates and applicable surcharge for company. Otherwise, you'll definitely solve question wrong. Okay, I want you all to score 14, at least 10 to 12 marks. I want you all to score in that question. So for that matter, you need to have a sound grip of these surcharge rates because question maker will be testing you on the surcharge ground. Is that clear? Yes, sir, we did understand your point. The next point is taxation of cooperative. If I could draw too many skulls on this, I would be drawing. If I could draw five skulls, I would be drawing because you are bound to forget tax rate of this cooperative society. I'm removing this page. Let me see how many of you can remember the tax rate of cooperative society without me telling you. How many of you can remember tax rates of cooperative society without me telling you? Arisa, we have come to you just to revise now. If we were already knowing, why would have come to you? Why we would have come to you? अरे बाबू थोड़ा सा तो recall, थोड़ा सा a bit of recalling is required ना, थोड़ा सा तो recall करेंगे ना. The tax rate of cooperative society up to 10,000, 10%, greater than 10,000, up to 20,000, 20%, greater than 20,000, 30% is the tax rate. And what surcharge is added to cooperative society? Abu, surcharge of company is added. Sir, surcharge of company is added here to 1 crore. Note surcharge up to from 1 CR to 10 CR, 7%, and greater than 10 CR, we have 12% surcharge. And in all the cases, 4% education cess is to be added. 4% education cess is to be added. Now let's solve a question. Let's solve a question. Let's solve a question. ठीक है. Mr. Rahul, age 30. Oh my God. Do I look like 30? But I have given. Okay. Previous year 23-24 total income is as follows. Long-term capital gain 112A. 112A long-term capital gain. The listed equity shares taxed at 10% over and above 10 lakh rupees. Over and above 1 lakh rupees. Sir, what will be the tax rate? Just give me a second. Huh? Just give me a second. Let me connect the charger to my iPad. Okay. Okay, got it. So long-term capital gain, that too under section 112A, how it is taxed. So greater than 1 lakh, we'll tax it at 10%. So tax will be 10% of 1.19 CR. That is 11 lakh 90,000. Long-term capital gain under section 112, 40 lakh. So 20% flat, directly 8 lakh rupees. Capital gain under section 111A, 3 CR at the rate 15%, 45 lakh rupees. Now we have dividend income and other income. Dividend income and other income. So simply we can say up to 5 lakh no tax, up to 2.5 lakh no tax. 2.5 to 5 lakh 5%, 12,500. 5 lakh to 10 lakh, 1 lakh tax, 20%. And greater than 10 lakh, up to 3.2 CR. How much? 93 lakh. Total comes to 94 lakh 12,500. This is how tax has turned out to be. I don't think anybody listening this video might have any issue with respect to tax calculation. Issue here is calculation of surcharge. What is the total income? Just calculate with me. What is the total income? Can I say कि total income is 7.8 CR? What will be the applicable surcharge rate? What will be applicable surcharge rate? We have to segregate the specially taxed income. We have to segregate the specially taxed income, and we have to segregate this income, other income. Specially taxed income will be surcharged at 15%. Specially taxed income will be surcharged at 15%, and other income will be surcharged at, if greater than 2 CR, will be surcharged at 25%. Got it, got it, got it. Which means all these taxes will be 15, all these taxes we'll add 15% as surcharge. And on tax on dividend income, we'll add 15%. But wait, do we have tax on dividend income? We have tax consolidated for dividend and other income as 94 lakh rupees. So we have to separate the tax on dividend income and tax on other income. And the tax calculated on the dividend income, we'll add 15% surcharge to that, and tax on balance income, we'll add 25%. Let's see how segregation process works. Just look at me what I am saying. All these three incomes, 11 lakh 90,000, 8 lakh, 45 lakh, and 94 lakh 12,500. Can I say this tax is on income of 3.2 CR? This tax is on income on 3.2 CR. So what will be tax on 2.2 CR? Simply, sir, no issue. Divided by 3.2 CR into 0.2 CR. Basic mathematics of class 11th. This is the tax on dividend. This dividend will be taxed at 15%, 588,281. After adding these three incomes, whatever tax is calculated, we add 15% to it. And balance tax, balance. What was the tax total? What was the tax on this 3.2 CR? 94 lakh 12,500. So what will be tax on 3 CR? Arey Babu, let's do a shortcut. We'll directly reduce 588 reduce from 94 lakh 12,500. We'll be getting tax on 3 CR will be 88 lakh 24,219, and this will be surcharged at 25%. This is how things have to be followed. This is how things has to be followed. Simply, other income will be surcharged at 15%, and we have to see what we have to see what we have to see. Other income will be surcharged at 15%, and what I am saying, specially tax income will be surcharged at 15%, and other income will be surcharged at 25%, as in our case. How bifurcation is to be made? Normally, you will find other income tax at other, specially tax income at special rate, but you have to bifurcate dividend. You have to bifurcate dividend on the basis of total tax liability. Whatever the income dividend possesses, you have to bifurcate on the basis of income. You have to bifurcate taxes based on the dividend income. Did you get this point? Yes, sir, we did understand your point. Let's see the answer that you have calculated. See, 5 lakh 88,000 and 88 lakh 24,000, 15%. Simple. What we have calculated is the right answer. How can it be how can it be wrong in any sense? If we have done hard work, how can answer be wrong? This was all about your surcharge concept and basic general tax rates for all the entities. Now we do have a very minute concept of marginal relief. You need to understand it really, really well, because many times what happens is you do remember, you do know under marginal relief, you do know marginal relief. But when this word strikes your mind, there is not too many things you can recollect. You often tend to confuse it with rebate 87A. So what is marginal relief? One line, what I am saying now, you have to remember. Tax on 4,999 and tax on 5,000,001. Just remember this. I want you all to calculate tax on 499 99999 versus tax on. I want you all to calculate for an individual. Take it for an individual. I want you all to calculate tax liability on these cases. Sir, up to 5 lakh, up to 2.5 lakh, no tax, no tax. 2.5 lakh to 5 lakh, 5%. For both cases, it will be 12,500. 5 lakh to 10 lakh, 20%. In both cases, it will be 10 lakh, 1 lakh. Greater than 10 lakh, up to total income, 30%. What will be tax rate? What will be tax? 147, 1, 2, 3, 4, 5. In both cases, tax will be same. Tax 148, 125, 0. This is the tax liability. In both the cases, tax liabilities is more or less the same. Income is just increased by 2 rupees and more or less tax liability same. But in both the cases, we have a slight difference. Surcharge. Sir, in this case, surcharge at the rate 25% will be applicable, and here in this case, 37% surcharge will be applicable. Here, surcharge 3703125 will be applicable. And here, surcharge. Let's calculate total tax liability. Total tax liability before. Okay. What is this? What is this? Can you see the difference? Income is increased by just 2 rupees. 2 rupees. Do you understand what 2 rupees is? Do you understand what 2 rupees is? Income is increased by 2 rupees, just 2 rupees. And tax is increased by nearly 17 lakh. Bhai sahab. Oh my God. This is increase in total tax liability. What difference did you find? Is there any difference in tax? No, there is no difference in tax. Difference is on account of surcharge. Can you see? Because of slight increase in income, there is marginally increase in tax just because of increase in surcharge bracket. Earlier you were falling under 25% bracket. Now you are falling under section 37 bracket, 37% bracket. Don't you feel you need to have some relief in this regard? Don't you feel it is irrational to ask 17 lakh rupees of tax from a person? Government says need not to worry. Government says need not to worry. Government says calculate tax. Calculate tax on 5 CR. Sir, if I calculate tax on 5 CR, I'll be giving this tax. I will be giving this tax 185,15625. Yes, because 25% surcharge will still be applicable to me. If I had income of 5 lakh rupees, if I had total income of 5 lakh, 5 CR, I was required to pay tax of this amount, and 25% surcharge was still applicable to me. My income would have been this. But because my income is increased by 1 rupee, is it correct is it correct to take 12% extra tax from me? Right answer, it is not correct. It is not correct. Government says you have earned 1 rupee more now. You have earned 1 rupee more now. Just surrender extra income to me. Like in this case, 1 rupee he has earned more than 5 CR. He has earned 1 rupee more than 5 CR now. Just surrender 1 rupee and you are required to pay this tax plus education cess. Which means what marginal leak means? What marginal leak means? Because of slightly change in surcharge bracket, your change in tax is significant. What government wants you To calculate tax on the nearest change bracket, like in this case, nearest change bracket was 5 CR. At 5 CR surcharge changes, government wants you to calculate tax on that amount and surrender the increased income. Whatever income you are earning more than 5 CR, just surrender that. If you will surrender that, you will be given relief of 17 lakhs. You will not be required to pay 17 lakh more. Sir, what is this? This even doesn't make any sense. But it is really important. Otherwise, sir, this would have been reality. If this marginal relief concept were not in fact in case, what would have been the case? We were required to pay tax of 2 CR. Just because of 1 rupee, there would have been increase of 17 lakh taxes. Did you get this point or not? Yes, sir, we did understand what you are trying to say. Let's see an example what your study mate says. See, study mate is full of examples. You will see many examples in this case. Let's see what example it says. This relief is given in case where there is significant rise in total income due to changes in surcharge bracket with little increase in income. Where we have only had 2 rupees increase in income, but with that we had significant increase in taxes. 17 lakhs taxes was increased. Example, person paying tax earning 4.99 CR pays 25% surcharge, but earning 5.01 CR pays 37% surcharge. In that case, calculation of marginal relief has to be done. Calculate tax on the original total income like we did for this amount. Without cess, we don't need to add cess here. Calculate tax, we have to calculate tax on the nearest bracket. Nearest bracket, like here we had 5 CR was the nearest bracket for individual. For firm, nearest bracket is 1 CR and company nearest bracket is 1 crore CR. We have to calculate tax as in the nearest bracket without education cess. See, we are doing this calculation without education cess. Later on, we'll be adding education cess. Now you have to see if tax calculated is as per step 2. On nearest tax bracket, pay tax that only and surrender over income. Government says tax step 2 plus extra income. Whatever extra income you are earning now, just surrender that. Don't pay tax on the original income. Just surrender the extra income over and above the surcharge bracket. Marginal relief will be whatever tax actually has been paid, whatever tax has been paid as per step 3 has to be reduced from original tax liability. Like in our case, what was the case? We are required to pay tax as per step 3 this. And originally we were required to pay tax 2 crores to 2.2 CR, 2.02 CR. So marginal relief will be difference in these two amounts. Difference in these two amounts will be marginal relief. I hope you understood what I am trying to say. An example is being given of Mr. Lavish, age 33, total income 5.1 CR. Tax liability will be around 2.03 CR. Tax liability will be around 2.03 CR, but restricted to we have to calculate tax on 5 CR and surrender total income minus 5 crore. That is the tax on 1 CR will be 185, 15625 plus we have to surrender 1 lakh. So we'll compare this tax calculated with the originally tax calculated. And whichever is lower, we'll be actually paying tax. And difference will be our marginally. I hope you did understand what I'm trying to say. Last but not the least topic before the break. Last but not the least is rebate under section 87A. If your total income, if you are resident individual and HUF, if you are resident individual and HUF and your total income is up to 5 lakh rupees, then you are entitled to rebate of 12,500 or tax payable, whichever is lower. You are entitled to rebate. This is rebate. This is not reduction in tax. This is rebate given by government. If government wants to relieve this rebate, it can remove this anytime. I want you to solve these two questions along with me. First, calculate tax on 4.8 lakh and calculate tax on LTCG. No, not LTCG. STCG 111A 4.8 lakh. Sir, calculate with me. 2.5 lakh, no tax. 2.5 lakh to 4.8. How much income it is? Into 5%. 11,500. What it says, 100% of the tax payable, 100% of the tax payable is nothing but 11,500 or 12,500, whichever is lower, we will be getting rebate. Sir, whichever is lower, that means 11,500 will be rebate. No tax is required to be paid in this case. But here, what happens? LTCC of 111 is taxable at 15%. Sir, for complete income of 4,80,000 will be taxable at 15%. That means tax liability turns out to be 72,000. In this case, what will be the rebate available to us? 100% of the tax payable, that is 72,000, plus or 12,500 or 12,500, whichever is lower. So here rebate will turn out to be maximum 12,500. What our tax liability turns out to be is 58,500. Did you understand the difference between two cases? In case where other income, we have only income as other income, or in case we have only specially tax income, how rebate turns out to be. I hope you understand what this lower implies and how income is calculated, how tax is calculated in these cases. Now, two things to be taken care of. This rebate is not available under section, not available for the income tax under section 112A. Any capital gain arising on account of 112A will not give, you will not receive any rebate against that. Second thing, if income exceeds even by 1 rupee, like we have income of 5.00001, no rebate is available. Of income up to 5 lakh rupees only, you are entitled rebate, otherwise you are not entitled in rebate. And last thing, rebate is calculated on gross tax liability. You don't have to add education cess on tax payable. Rebate is given on gross tax liability. Once you are finalized with taxes, you have to add education cess on that. Like for example, in our case, we had 72,000 rupees of taxes or 12,500, whichever is lower, we were entitled rebate. So our tax liability turned out to be 59,500. Now you have to add education cess on this. You don't have to add education cess while calculating the taxes for rebate purpose. Did you get this point? I hope you did understand what I'm trying to say. These all were very basic concepts. After this, we'll be starting with concept of capital gain. 15 minutes break I'm giving you for now. Do not use Instagram in between class. Do not sit with Aratircha posture. Do not use YouTube during this session. I humbly request you, just sing songs, hear songs. If you want to talk to somebody, talk to them. Want to have a walk, just have a walk. If you want to have a bath, just have a shower. I have no issue with that. But stay away from mobile phone for the break period. I don't want you to waste your time on mobile phone during this break. This break is really crucial for your power batch, and I really want you all not to waste this break. See you all after 15 minutes. Welcome back, everybody. Hope you all are back from your break and you did not use any Instagram or any social media app during this break. Before switching on to the next topic, I must tell you a major concept, very important concept for the exam. It can come for 1 mark in your MCQs, so you must be aware of this fact. Difference between application of income and diversion of income. Just imagine an example. Sarthak sir pays me salary every month. I asked Sarthak sir to donate 50% of my salary to Tirupati Balaji Trust. Now, in whose hands the salary will be taxable? The right answer is, since salary is being accrued to me, it will be first taxable in my hand. Then it will be treated as application. I will be giving it as donation, and that salary will again be taxable for Tirupati Balaji Trust. That means if I receive an income, I transfer it to any other SSC out of no obligation. Out of my will, I am transferring them. Then it will be treated as application of income. In such cases, that salary is taxable in both the hands. Not just me, but in both the hands, it will be taxable. But on the other hand, we have a concept called diversion of income. In this case, salary will not be taxable in my hand, rather it will be taxable directly in the SSC who receives it. For example, we have 3 partners ABC. It is written in the partnership deed that whenever A dies, his share of profit will be given to wife of Mr. A. Partnership says we have 3 partners. In case of death of Mr. A, all the profits accrued to Mr. A will be transferred to Mrs. A. In that case, all the profits that are being transferred to wife of Mr. A will be taxable in the hand of wife only. They will not be taxable in hands of Mr. A. This concept is called diversion of income. If I clearly ask you to read, it says income earned by the SSC but transferred by the SSC on account of agreement or as per law. If income is being transferred on account of agreement or as per law, then it is taxable in the person to whom it is transferred, not taxable to the person who receives such income. Did you get this point or not? Yes, sir, we did understand what you are trying to say. This was a basic concept I expected everybody to know. Let us switch to next topic, or I should say next chapter. Income from capital gain. Really very important chapter from understanding point of view. You need to have a of this chapter. One thing everybody must understand that during last 1.5 day, it might be possible that you may not be able to give sufficient time to this chapter. It might be possible that you will be in a hurry and you will be just wiping up the pages. For that matter, you need to have a strong grip over this chapter today itself. So on last day, most of your time is not taken up by this chapter. Did you understand? So for that matter, you have to revise this chapter multiple times. Let us revise it for the very first time now. Income from capital gain. First of all, every income that is chargeable under any head has a charging section. Every head of income has a charging section which tells what type of income is taxable under this head. We have 5 heads of income. Everybody knows we have 5 heads of income: income from salary, house property, income from capital gain, PGBP, and other sources. For capital gain, section 45 says, section 45 is the charging section of the capital gain. It says, any profit arising from the transfer of the capital asset shall be taxable under the head capital gain in the year in which transfer took place. What I said, just repeat after me. Any profit arising from the transfer of the capital asset shall be taxable under the head capital gain in the year in which transfer took place. So here 3 takeaways are from the definition. We need to understand the meaning of transfer. Transfer of capital asset, what capital asset implies. And third thing we need to understand is taxable in the year of transfer. These 3 things we need to understand. And as soon as we are done with this portion, we will be completing this chapter. We will be completing the computation portion or definition portion. Did you get me or not? Okay, sir. We did understand. First of all, let me brief you how chapter flows. So it will be easier for you to understand where we stand right now. Always, when you are studying capital gain, you need to understand that you have to bifurcate this chapter. You have to bifurcate chapter into charts. First part is definition. Capital gain. Definitions. Definition includes 3 parts. First of all is transfer. Second includes capital gain. What is capital asset? And third includes period of holding. These 3 definitions we have to cover. This will complete major portion of your definition portion. Second thing involves computation. How capital gain is computed. It involves first thing, normal calculation. Second thing it involves is provisos to section 48. Section 48 prescribes how capital gain is computed, and its provisos tell what things you have to take care while calculating the capital gain. So we need to understand the provisos to section 48. Apart from computation, we need to understand how full value of consideration is calculated and how cost of acquisition is calculated. It is very simple how capital gain is calculated. Sales price minus cost price. Sales price minus cost price is nothing but capital gain. But how sales price is calculated, how cost is calculated, we need to understand that too. So that is also one of the topic to be studied. Or I will be referring this topic as calculation of sales consideration. Many a times you may see this topic as full value of consideration also. They both are same. Last is cost of acquisition. How cost of acquisition is calculated? This is the last part of the computation portion. This is not the portion from which examiner asks the question. Examiner normally tests you on the next topic, that is special cases in capital gain. Special cases we do have 2 parts, part 1 and part 2. I'll talk about this later on. Next one is exemptions in capital gain. How can you save capital gain? Next one is tax rates. What tax rates are applicable in capital gain? And last one is exempt transfer. In what cases there will be no capital gain applicable? So these are Broadly, six categories or six topics that you need to understand in this capital gain to complete this chapter holistically. Out of which the best portion, the most important portion is special cases. We will be giving more emphasis to this, but not today. We'll be trying to do part one till part one of the capital gain today itself. Let's start from definition. Let's start from definition. First of all, definition of capital gain or charging section. What charging section says: capital gain shall be taxable, or capital gain, any gain arising from the transfer of capital asset shall be taxable under the head capital gain in the year in which transfer took place. First definition, we need to understand what is capital asset. First and the foremost thing that you need to understand what is capital asset, how income tax describes what is capital asset. You need to understand three things are capital asset. Three things are capital asset. What three things are capital asset? First of all, every asset is a capital asset. What I am saying, you need to understand what is capital asset. First thing, every asset is a capital asset, but you have to exclude four things out of this. First of all is stock in trade. Every stock in trade held in business is not a capital asset. Second thing, any kind of movable personal asset like car, like mobile phone, like you have earphones, like you have camera, anything that is movable and personal is not a capital asset. What I'm studying, every asset is a capital asset, but movable personal asset are not capital asset. Next one is rural agriculture land. Any rural agriculture land is not a capital asset. And last one is gold deposit bonds and deposit certificate 2015. These four things, despite of being assets, these are not capital assets. But one thing to be taken care of is, even if all the movable personal assets are not capital assets, these few will be classified as capital asset. What are any kind of drawings? Any kind of drawings, like we had Majnu Bhai's painting. If you remember Welcome movie, he had a donkey ridden on another donkey. That was a painting. That was a drawing. That is a capital asset. A painting by Leonardo da Vinci, painting of Mona Lisa, will be also a capital asset. Any kind of jewelry, any kind of watch that you have, if it is laden with diamonds, it will be considered as jewelry. Any type of sculptures, any type of archaeological collections, or any other form of art, despite of being movable personal asset, they will be considered as capital assets only. So what did I say? Every kind of asset is a capital asset, but these four assets are not capital assets. Stock in trade is not a capital asset. Movable personal assets are not capital assets. Rural agriculture land is not capital asset, and gold deposit bonds are not capital asset. Some of the movable personal assets will be capital assets, like any kind of drawing, painting, sculptures, archaeological collections, any other form of art, jewelry, and I should say bullion. These all are movable personal assets, but yet they will be capital assets. Second thing will be capital assets are Second things that will be classified as capital assets are any securities held by FIIs. If you understand FIIs, their business of FIIs is investing in securities. The primary business of FIIs or foreign institutional investors is to invest in securities and earn from price fluctuations. Now, what if you treat their income as business income? They will be chargeable to tax at the rate 40%. Will it be justified for them? They will not be willing to invest in India. Therefore, it has been clarified that every investment, every securities held by foreign institutional investors will be classified as capital asset only. Whatever the rate given for capital assets will be chargeable for FII's securities only. Last but not the least, any kind of ULIP to which section 1010D does not apply or issued after 1st February 2021 and aggregate premium exceeds 2,50,000 in the previous year is a capital asset. We'll talk about this later when we'll study ULIP taxation. We do have things in depth. You need not to worry about this. So what I said, what is a capital asset? Focus on the screen. Every asset is a capital asset, but four things to be excluded. Stock in trade is not a capital asset. Movable personal assets are not capital asset. Rural agriculture land is not capital asset, and gold deposit bonds are not capital asset. But jewelry, drawing, painting, sculptures, archaeological collections, any other form of art, despite being movable personal asset, will be considered as capital asset. Second thing, any securities held by foreign institutional investors will be classified as capital assets. And last one is any ULIP to its exemption to section 1010D does not apply and issued after 1st February 2021 and aggregate premium exceeds 2,50,000 will be considered as capital asset. Hope you understood what capital asset is. Let us understand a few notes on this. Any asset like TV, car, mobile phone. Since TV, car, mobile phones, these are personal assets. These are personal assets and these are movable assets. So they will be excluded from the definition of the capital asset. Therefore, no capital gain will arise on such transfer, on transfer of such assets. But if you transfer any jewelry or any painting, these are capital asset, capital gain will be leviable. I think you must be finding this very basic. But let me take my time to build your concept. Because once we are clear with these concepts, it will be easier for me to jump on difficult topics easily. So it will take some time to build the base. Once base is built up, then it will be easier for me to jump on the difficult topics. So need not to worry. We'll take our time. We'll complete topics on time. For example, a car is used for business. Sir, a car is used for business. Since it is movable, it is not personal. If a car is used in a business, it is movable, but it is not personal. It is commercial asset. So it will be considered as capital asset. What if, sir, somebody eats food in silver utensils? Can it be considered as capital asset? They are movable, they are personal, but they are a part of jewelry. Silver is a kind of jewelry, but Supreme Court held that since silver is of personal effect, jewelry is of, sorry, silver utensils is of personal effect, it cannot be considered as capital asset. See what happens if you sell silver utensils, which you were using for eating food, they should not be considered as capital asset. Supreme Court felt like that. So Supreme Court held that any kind of utensils, any kind of silver utensils are personal effect and there will be no capital gain arising out of it. Next thing, but if you hold any gold, but if you have any gold plate, if you have any gold utensils, they can never be considered as personal asset. Capital gain will be eligible, where capital gain will be applicable on transfer of such utensils. So that thing you need to take care of. If you are transferring any silver utensils, no capital asset, no capital gain. But if you are transferring any gold utensils, they will be considered as capital gain and capital gain will be applicable. These are some basic things you need to know. Now, next point is, I said 4 assets will not be considered as capital asset. We said stock in trade will never be capital asset, movable personal asset will never be capital asset, rural agriculture land in India will never be considered as capital asset, and gold deposit bonds are never capital assets. But what is rural agriculture land? We need to understand. We really need to understand what is rural agriculture land. For that, section provides definition of urban agriculture land. Section provides definition of urban agriculture land, and later on it says any kind of land which is not urban shall be termed as rural. So for understanding the meaning of rural agriculture land, we need to understand the definition of urban agriculture land and what it says. You have to imagine, you have to picturize along with it. Any area, for example, this is an area which is governed by municipality, and population of such area is up to 10,000 people, then this area will be urban area. Beyond that, any area will be rural area. But what if population increases from 10,000? What if population increases from 10,000? Government says, or the provision says, if population increases from 1 lakh, from 10,000 to 1 lakh, if population is between 10,000 to 1 lakh, then area covered by municipality and 2-kilometer area from its radius, 2 kilometers additional area from its radius will also be considered as urban area. Beyond that, any area will be rural area. Beyond that, any area will be rural area. What if population is more than 1 lakh? Then provision says area covered by municipality and 6-kilometer area. 6-kilometer area from the center of this municipality will also be urban area. If population is greater than 1 lakh, but up to 10 lakh, then area surrounding 6 kilometers from the municipal limits will also be considered as urban area. Beyond that, any area will be rural area. What if population is more than 10 lakh? Simply provision says if population is more than 10 lakhs, then any area governed by municipality and surrounding 8 kilometers area from its radius, from its ends, 8-kilometer area will also be considered as urban area, and any area other than this urban area will be rural area. I hope definition is very clear to you that what is meant by rural area. What is meant by rural area? Just repeat after me. Any area Municipality or cantonment board having population of 10,000 or more is a urban area. Second thing, if population is more than 10,000 but up to 1 lakh, any area of municipality and 2 kilometers area beyond that will be urban area. If population is more than 1 lakh but up to, sorry, if population is more than 1 lakh but up to 10 lakh, so any municipality area and 6 kilometers surrounding area will also be urban area. And if population is more than 10 lakh, then any area beyond 8 kilometers of the municipality limits will also be considered as urban area. Any area beyond this urban area will be rural area. Did you get my point or not? One thing is to be taken care of. How this area is calculated? What if there is a terrain between? What if there are some potholes between? Do we consider the distance of such potholes or such areas? No, you have to see bird eye view. You have to see drone eye view or bird eye view, I should say. If a drone looks at an area from the topmost height, how area will be calculated? You have to look such area. That means distance is calculated from bird's eye view. If a bird looks out for that area, how that area has to be seen? You have to look for that distance. You have to look for that distance. Did you get me or not? Did you get me or not? This was the definition of capital asset. You should be very much aware of. You should be really very much aware of. Next thing, what is meant by transfer? Sir, what is meant by transfer? Earlier, na transfer used to mean just sales. Earlier, transfer used to mean just sales, but later on, income tax felt a need to change the definition of the transfer. From now onwards, transfer includes any kind of sale. If you are selling any capital asset, it will be considered as transfer, and capital gain will be leviable. If you exchange any asset, for example, I have a land, I exchange it with a house, this will be considered as transfer and I will be charged capital gain on it. We have relinquishment of an asset. What is meant by relinquishment of an asset? For example, I gift my asset to somebody. If I gift my asset to somebody, I relinquished my asset. That relinquishment will also be considered as capital transfer. And if such transfer is for capital asset, I will be charged capital gain. Transfer also includes extinguishment of any rights therein. For example, I had rights in company share. I have shares of a company. I had rights in the company. What if company proposes a buyback? What if company proposes a buyback? In that case, my shares right will be extinguished. In that case, buyback will also be considered as transfer and capital gain will be leviable. Did you understand what extinguishment means? I have right in something and that right is extinguished. Then such thing will be considered as transfer. I had a land. I did not intend to sell. I did not intend to transfer. I did not intend to do anything. But government purposively, compulsorily acquired such land from me. There was a railway construction going on. There was a railway line to be passed from that land. Therefore, government compulsorily acquired such land from me. Then compulsory acquisition of such capital asset will also be considered as transfer. Despite whether I was willing or not, that compulsory acquisition will be considered as transfer. Next point. If I convert my capital asset into stock in trade, just look at this example. My mother used to save jewelry for herself. Mother used to save jewelry for her. Daily, every month she used to buy 10 grams of gold. After efforts of 30-40 years, she was able to save 3 kg of gold for me. 3 kg of gold she was able to save for me. One day what I did, I thought I am worthless. I thought I am worthless. I want to start a jewelry shop. From that day onwards, I did convert this capital asset into stock in trade. I took all this jewelry and put it in my shop and I started a jewelry store. On that day, I converted my capital asset into stock in trade. Provision says as soon as you convert your capital asset into stock in trade, it will be considered as transfer and you have to pay capital gain on that. We do have things in detail, but for understanding the meaning of the transfer, conversion of capital asset into stock in trade will be considered as transfer. Sir, allowing possession of immovable property in part performance of the contract. For example, we are two friends. We did a contract. We did a contract that I will be giving you house. You can use it anytime. You can use it. You paid consideration for me, but you did not register for yourself. You did not get a registry done for your house. You just took the possession. You gave me money, but you did not register that house. Does that mean that house is with me, or that house is with you? Right answer is, I am still the owner of that house. Even if the registry is not register till the time registry is not done, I am the owner of that house. But since he is using that house for his benefit, can I say ki in the part performance of contract he is being allowed the possession of the property? Can I say in part performance of the contract he is being allowed to use the possession of immovable property? Right answer is, he is allowed to use such capital asset. In that case, that part performance of the contract will also be considered as transfer. Next thing, any transaction which has the effect of enabling enjoyment of immovable property. It means, for if you know, we have a concept in cooperative societies. That actual registry is not being made in your hand. You are just being entitled to a certificate of residence in such cooperative society. Now, since registry is not being done in your hands, does that mean that any sale of your house, capital gain will not be taxable in your hands? Just that you house is not being registered in your name, any transfer made by you will not be taxable in your hand. Right answer is no. Now, if you are enjoying any property, without getting ownership of it, and you transfer that, capital gain shall still be taxable in your hands. This is what this says. Any transaction which has effect of enabling the enjoyment of immovable property shall be considered as transfer. And last thing is redemption of zero coupon bond. For example, if a bond has a face value of 1,000 rupees, and it is being issued to it is being issued at 900 rupees. There is zero coupon rate. There is no coupon. There is no interest payable. But on the maturity, 100 rupees extra will be given to the person subscribing for such bonds. These concepts are called zero coupon bonds. This gain, whatever the gain that the person subscribing has, will be taxable under the head capital gain, and there will be no interest concept. There will be no taxability under the head interest. Complete gain will be taxable under the head capital gain. That redemption of zero coupon bond will be also considered as transfer. Did you understand what transfer means? Yes, sir, we did understand. Based on these 7 meanings, based on these 7 instances, we have derived a series of transactions that are considered as transfer based on these 7 meanings only. This has been solely derived by me, so that anytime when you see these words, capital gain should click in your mind. What are those cases? If a capital asset is destroyed and amount is received from insurance company. Can I say when a capital asset is destroyed, there is relinquishment of an asset, or I should say extinguishment of any right in the asset? Can I say that? If I have a property, if I have a building and that building is destroyed in a riot, if that building is destroyed in an earthquake, can I say I have relinquished that asset? Right answer is, there is relinquishment of asset, and capital gain will be taxable in the hands of the one owning the asset. What if I give an asset to a partnership firm? I am a partner in a partnership firm and I give assets to such partnership firm. Can I consider that as a transfer? Right answer is yes, that will be also termed as transfer. In that case, capital gain will be applicable in my hands. I have extinguished my right in the assets, therefore capital gain will be applicable in my hands. Vice versa is also true. If a partnership firms transfers any asset, partnership firms gives any asset to partner, in that case it will be termed as transfer, because partnership firm again relinquished the asset. It will still be treated as transfer, and capital gain will be leviable in the hands of partnership firm. If a company goes into liquidation, and it distributes its asset to the remaining shareholders, can I say rights of the assets are being relinquished by the company? Or can I say rights of the shareholder are being extinguished here? If a company is being liquidated, can I say all the share capital that has been issued by the company are being extinguished? Every shareholder is being given their share of assets. That means rights in the company are extinguished, which means liquidation of the company shall be treated as extinguishment in the rights of the shareholders. In that case, shareholders will be charged capital gain on account of such transfer. Or I can say liquidation is also a transfer in short. If a company comes up with a buyback, can I say again there is extinguishment of any rights therein? Shareholders lose their rights in the shares of the company. In that case, it will be treated as transfer, and and therefore capital gain will be applicable in the hands of the shareholders. Last but not the least, any kind of slum sale being done. What is slum sale? We'll understand later. We do have depth coverage of slum sale. Transfer also includes disposing. If you are selling any property, if you are parting any property, or if you are creating any interest, for example, you are giving it on hire purchase, it will still be treated as transfer. Whether you do it directly or you do it indirectly, it will still be treated as transfer. Whether you do it conditionally, whether you do it unconditionally, whether by agreement or not, in all such cases, transfer, it is considered as transfer. I need your attention for 2 minutes. I need you all to understand a basic concept of indirect transfer. What happened is, there was a case law named Vodafone PLC case law. What happened here was there is a company named Hutchison SR in India. Hutchison SR India. It was a subsidiary of a company called CGP Mauritius. CGP Mauritius held 67% of the Hutchison SR. CGP had an ultimate parent called HTIL Singapore. HTIL Singapore. HTIL Hong Kong it was. And we had a party called Vodafone PLC. What case law was? Vodafone PLC was willing to expand their operations in India. For that matter, it wanted to acquire Hutchison SR. Vodafone PLC, a third party, wanted to acquire Hutchison SR. Now, how could have it acquired Hutchison SR? It could have directly gone to CGP Mauritius, asked for such 67% shareholding, and Vodafone PLC would have got the ownership of such Hutchison SR. Simple transaction. It was a simple transaction. Na? CGP Mauritius could have simply sold 67% of their shareholding in Hutchison SR to Vodafone PLC. What would have been that done? What would have been the case? Simply capital gain would have been applicable in the hands of CGP Mauritius in India. Since asset is located in India, you do understand, asset is located in India, any transfer made by the third party of such Indian assets will be taxable in the hands of CGP. So this was the major issue. This was only the major issue. STIL never wanted to pay taxes in India. STIL never wanted to pay taxes in India, and what STIL did, what STIL did, just listen. Instead of transferring 67% of the shareholding to Vodafone PLC, what STIL did, STIL transferred shares of CGP Mauritius to Vodafone PLC. Now what the case has turned out to be, just understand. Buyer of the company is a non-resident. Seller of a company is a non-resident. The shares transferred are also not located in India. Can I say this transfer will be taxable in India? Can you say that this transfer is taxable in India? Right answer is, in old case laws, in old income tax provisions, this was not taxable in India. This was not taxable in India, nor there was any provision to tax such transactions. In that case, STIL was validly rescued from paying taxes in India. But one of the Bombay High Court judge, I should say Maharashtra's AO, assessing officer, one of the Maharashtra's assessing officer, Mumbai's assessing officer, accused Vodafone of not deducting TDS of such transaction. What was the case law? Do understand. A AO from Bombay or Maharashtra, I should say Mumbai, accused Vodafone PLC for not deducting TDS on this transaction. You are very much aware of the fact that person who is earning capital gain is not required to pay tax. If a person is non-resident, he is not required to pay tax. Ultimate liability lies upon the person who is responsible for paying consideration. He is liable to deduct a TDS on such transaction and deposit it to government. AO accused Vodafone PLC, you have not deducted any TDS. Case went to Bombay High Court. And Bombay High Court or Mumbai High Court held that It is correct. It is correct that TDS was required to be deducted. Hence, Vodafone is guilty. Even if there was no provision for TDS deduction for such transaction, Bombay High Court held that Vodafone is guilty of such misconduct. Vodafone is guilty. Bombay High Court held. What Vodafone could have done in that situation? Vodafone went to Supreme Court. Vodafone went to Supreme Court and Vodafone. And what Supreme Court did, do you know? Supreme Court said that since you don't have any provision for taxing such transactions, Vodafone was not required to deduct TDS and Vodafone is not guilty. Supreme Court overturned the decision of the Mumbai High Court and claimed that Vodafone is not guilty. There was no tax incidence in this transaction. There was no requirement of any tax incidence because your tax laws, it said to government that your tax laws do not have any taxing rights in this transaction. Your tax laws don't say anything about taxing such transactions. Therefore, tax was not required to be deducted. Many government officials claimed at Supreme Court that you are giving a lacuna in law. You are giving an opportunity or a loophole for different stakeholders who can find difficulties in law or who can find loopholes in law for tax avoidance. Many advocates went to Supreme Court, but Supreme Court said it is not our duty to draft the law. Whatever law has been drafted, we are here to interpret such law. And after interpreting your law, there is no incidence of tax, there is no requirement to deduct TDS. We have just interpreted your law. We cannot draft it. Ultimately, what was held? Vodafone PLC was not held guilty by Supreme Court. There was no tax liability on account of Vodafone PLC. What's government did? Government proposed an amendment. What government did was government overturned the decision of Supreme Court and brought an act to tax such transaction retrospectively from 1976. Government brought an amendment to tax such transaction retrospectively from 1976. Now what happened? Again, Vodafone PLC was required to pay tax, overturning the decision of Supreme Court. What Vodafone could have done? Since if Vodafone would have been an Indian entity, till now it would have filed for liquidation. But since it was not Indian company, it dragged the Indian government to international arbitration where it was held that Vodafone is not guilty. Indian tax provisions did not inculcate any provision for taxing such transaction. So retrospectively amending the tax laws is not sufficient for taxing such transactions. International arbitration held that. Ultimately, what happened was government introduced an amendment which involved government included an amendment which involved taxing such indirect transfer. Did you understand how this is an indirect transfer? Did you understand? STIL could have easily sold the shares of the Hutchison SR 67% to the Vodafone PLC. But to avoid tax, they did not sell this Hutchison SR. Rather, they sold this CGP Mauritius. So instead of directly transferring the shares of the Indian entity, they transferred the share of another entity which has his holdings in Indian entity. So this is termed as indirect transfer from Finance Act. I guess it was 2009. I guess it was 2009 when this amendment was proposed and amending the definition of the transfer. Now the definition of transfers also includes any transfer made indirectly. Therefore, the word indirectly is introduced. Therefore, the word indirectly is introduced. Did you get this point or not? Yes, sir, we did understand. Now, definition of capital assets. Sir, what are capital assets? Or sorry, types of capital assets. We have two types of capital asset. It can be either short-term capital asset or long-term capital asset. Any kind of gain arising from short-term capital asset will be short-term capital gain, and any kind of capital gain arising from long-term capital asset will be long-term capital gain. How we have to classify whether capital assets are long-term or short-term? It is dependent upon period of holding. For every class of assets, we do have a list of period of holding. If you hold such assets for longer than required period of holding, it will be deemed long-term capital asset. If you hold for lesser duration than prescribed, then it will be short-term capital asset. What is the period of holding for different assets? Do we need to learn, sir? Do we need to learn? Yes, you have to learn such period of holding. This is the period of holding. Any listed securities other than units of the business trust on the recognized stock exchange. Any listed securities on recognized stock exchange other than unit of business trust, or any units of equity oriented mutual funds, or any zero coupon bonds, or any units of UTI, if held for more than 1 year, they will be termed as long term capital asset. Lesser than 1 year, they will be termed as short term capital asset. Any unlisted shares, like any shares other than category 1, any other shares will be deemed to be long term if held for more than 2 years, or they will be deemed as short term if held for lesser than 2 years. Any kind of immovable property possesses the same period of holding, 2 years. If held for longer than 2 years, they will be long term, otherwise short term. And any other asset, for example, debt oriented mutual funds, or any kind of slum sale, any other asset now, if held for more than 3 years, they will be termed as long term capital asset and otherwise short term capital asset. Now I have a few examples that you need to solve. Find out period of holding. First, shares of Facebook. Gold. Debt oriented mutual fund. Units of business trust. Slum sale. Determine period of holding. What period of holding to be looked upon to classify it whether capital asset is long term or short term? What period of holding to be looked upon? Preferentials. What period of holding to be looked upon? The shares of Facebook. Shares of Facebook. Sir, are they listed? No, they are not listed on recognized stock exchange. Recognized stock exchange is nothing but National Stock Exchange and Bombay Stock Exchange. These are only the recognized stock exchange. Any other stock exchange, be it New York Stock Exchange, be it Nasdaq, all will be considered as not recognized stock exchange. They will never be considered as recognized stock exchange. So can I say any kind of shares not covered above will be considered for 2 years of period of holding? Yes, sir. Shares of Facebook to be checked for 2 years. What shall be the period of holding for gold? What will be the period of holding for gold? Sir, they do not fall under 1 year category. Okay. They do not fall under 2 year category. Okay. Do they fall under 3 year category? Right answer is yes, they fall under 2 year category. They will be having period of holding 3 years. So debt oriented mutual funds. Okay. For 1 year, we have equity oriented mutual funds. It is not equity. 2 years, nothing stated. Any other assets, we have to consider 3 years. Units of business trust, sir. Units of business trust units are listed on recognized stock exchange. But it says other than units of business trust, which means we do not have to look 1 year for business trust. For units of business trust, period of holding 1 year is not to be considered. So what is to be considered? Again, it will be classified as any other assets and 3 years to be looked upon. So slum sale, again any other asset, 3 years. Preference shares, so preference shares, 3 years, 3 years, 3 years. No, preference shares is not 3 years. See, unlisted shares or any shares that are not covered above. Since unlisted shares are not covered above, that means period of holding for 2 years to be looked upon. So if you hold preference shares for 2 years, they will be termed as long term, if otherwise short term. How many of you did give all six correct answers? Do message me on Telegram. I will be writing a great congratulations for all of you. Just come to board notes. Can I say we are done with definition portion? We did understand the meaning of the transfer. There were seven parts. sale, extinguishment, relinquishment, capital asset conversion, compulsory acquisition, using the property without possession, zero coupon bond. Did we understand the meaning of capital asset? Any kind of asset is a capital asset. FIIs, holdings, or ULIPs, except four assets, movable personal assets. We did understand the meaning of capital asset, and we did understand the meaning of period of holding. What are the types of the capital asset? We are done with the definition portion. Now we have to go for computation portion. How to compute capital gain? How can a thing be simpler than this? So simply sales full value of consideration minus cost of acquisition. If you buy a share, just imagine if you buy a share at rupees 100 and sell at 200, what will be capital gain? What will be capital gain? Simply 200 minus 100 will be capital gain. Capital gain will be 200 minus 100. That is simply the capital gain. This is what you have to do. Sales consideration, or I should say full value of consideration, minus cost of acquisition. Minus cost of acquisition will be capital gain. But provision says a bit more. Provision says consider full value of consideration, whatever the full value of consideration has been derived from such sale. Exclude transfer expenses, what any kind of brokerage you have paid, any kind of commission you have paid for such transfer. You have to reduce that. After reducing such expenses, the term point here is net consideration. This is the net consideration, all in all net consideration that you have received from such transfer. From such net consideration, you have to reduce cost of acquisition or index cost of acquisition. What is cost of acquisition? The price that you have paid to buy such asset. Or index cost of acquisition, that means you have to give impact of inflation to it. We'll study about this. Any cost of improvement, for example, you have bought a house, you have included it in cost of acquisition, but you have constructed a balcony, so it will be considered as cost of improvement. Any cost of improvement made will be reduced from net consideration, and after reducing all such expenses, we will be arriving to our capital gain. And depending upon period of holding, if such period of holding is more than as prescribed above, it will be long-term capital asset, long-term capital gain, or it will be short-term capital gain. Did you understand how we have to do the computation portion for capital gain? Here you understand how we have to compute, how we have to do computation portion. In this aspect, we have three things to learn. First one is to calculate full value of consideration. Second thing, to calculate cost of acquisition. And third thing is provisos to section 48. Proviso to section 48. We have all in all 7 provisos to study. What we are studying, computation of capital gain. Computation of capital gain involves 3 parts. First of all, 3 parts other than normal calculation. This is the normal calculation. Whatever sales price you are getting minus transfer expenses will be termed as net consideration, and reducing cost of acquisition, reducing improvement will give us capital gain. Now we have to make certain adjustments in these things. We have to find out full value of consideration, and we have to find out cost of acquisition. After deriving all these things, we will be getting long-term capital gain or short-term capital gain. Let us switch to provisos to section 48. Firstly, we will study second proviso, proviso 2 to section 48. What the second proviso says, do listen. If you are transferring any asset which is long-term capital asset, if you are transferring any capital asset which is long-term capital asset, any capital gain will be long-term capital gain. It is very simple. Any capital asset transferred which is long-term capital asset, capital gain will be long-term. Provision says, second proviso says, if you are transferring any capital asset, cost of acquisition will be considered as index cost of acquisition. Sir, what does that mean? You have to index the cost. You have to give impact of the indexation. For example, think of a house. You are selling it at 60 lakh rupees. You bought it at 15 lakh rupees. Is it wise to just reduce cost of acquisition from the sales price? Is it correct that 45 lakh is the correct capital gain? Since so many years, there were too many inflation impacts in this house. Is this my real gain? Government wants to remove this inflation. So what it said, you do not consider this cost of acquisition. You index this cost of acquisition, divide it in the year in which you bought, and multiply it with the year in which you are transferring. You have to multiply or divide it with certain index numbers so that your cost of acquisition is inflated. It is adjusted to inflation so that your capital gain is minimal. It is adjusted to inflation. Did you get this point or not? This simply says whenever you are computing cost of acquisition, cost of acquisition shall be indexed. How indexation is to be done? You have to divide by cost of inflation index of a year of acquisition. Cost of year of acquisition, cost of inflation index of year of acquisition, and multiply it with cost of inflation index of year of transfer, so that you get cost of acquisition as index cost of acquisition. Let us see how index numbers go, how index numbers flow. For financial year 1 2 we have 100. Every year this inflation index was increased. Every year this inflation index was increased, and for financial year 23-24 it is 348. This simply implies if an asset was purchased for 100 rupees in previous year 1 2, in financial year 1 2, its acquisition cost will be 348, adjusting the inflation in financial year 23-24. This is the impact of inflation. We are giving it to cost of acquisition so that our capital gain is minimum. Did you understand this point or not? Yes, sir, we did understand what you are trying to say. Okay, okay. Sir, there is a doubt coming to our mind. There is a doubt. We have index number from 100. We have index number from 100. What if our asset was bought before 2001 and 2? What if our asset was bought before financial year 1 2? For that matter, government has proposed a FMV concept. Government said whatever actual cost of acquisition, if your house is bought before financial year 1 2, if your house is bought before 1st April 2020 to 2001, what cost of acquisition you will be considering? Government said you can either consider cost of acquisition or FMV on 1st April 2001, whichever is higher. This will be considered as your cost of acquisition, and depending upon whichever is higher, you will be allowed to divide by 100 and multiply by year of transfer. Multiplied by year of transfer. Did you get this point or not? In case of any property bought before 1st April 2001, consider you have to consider FMV of such property. But there is a catch. There is a catch. Since you are being allowed to use FMV, it is bound that you will be inflating such FMV. Getting me or not? If you are allowed to choose FMV, if you are allowed to find out the FMV, you will be choosing the highest FMV so that your cost of acquisition gets higher, and you are required to pay least taxes. So government brought a condition in this. If you are transferring any immovable property now, if you are transferring any immovable property and stamp duty value of such property is available, then your FMV cannot be greater than stamp duty value. Your FMV cannot be greater than stamp duty value. But if there is no stamp duty available, then FMV derived, whatever FMV derived shall work. For example, understand this with an example. House bought in year 1980 for rupees 5 lakh. Sold in year 23-24 for 1 CR. FMV on 1/4/2001. How FMV will be derived? Simply FMV will be derived by a chartered accountant's valuation report or merchant valuation report, or FMV is available in many of the books. Many of the areas, localities, FMV is available. How FMV will be derived? You will try to maximize this FMV. You will try to maximize this FMV to get least tax available, to get the least tax available. For example, by your will, if FMV is available by your will, you will try to maximize FMV to 50 lakh rupees now. You will try to maximize FMV to 50 lakh rupees. But guideline value or stamp duty value of area is nearly 10 lakh. Is 10 lakh. How capital gain will be computed? Just have a look. Sales consideration will be same 1 CR. Cost of acquisition, what it says, what if says cost of acquisition, actual cost of acquisition, or FMV you have to consider. Sir, FMV. But if SDV is available, FMV cannot be greater than SDV. Yes, FMV cannot be greater than SDV if FMV is available. So what will be cost of acquisition? Our cost is 5 lakh. FMV is 50 lakh. But since we have SDV available and SDV is 10 lakh, so FMV cannot be greater than SDV. So SDV will be 10 lakh. In this case, your excessive cost of acquisition will be eliminated. Your attempt to trick the department and pay the least tax available is being rescued by, is being eliminated here. You cannot attempt to pay lower taxes by just inflating the FMV. Did you understand this point or not? This concept is only available for removal property. Otherwise, for any other asset, for example, if you are selling gold, any FMV derived shall work. So in that case, you can still do anything, any kind of trickiness. But for property, if SDV is available, you cannot trick department. You cannot trick income tax department in that sense. Sir, what if we have done improvement before 1st April 2024? How will that improvement be? How will we find out fair market value of improvement? How will we find out the fair market value of improvement? The right answer is you have to ignore such improvement. Why, sir? Why we are supposed to ignore that improvement? Government says when you are considering FMV as on 1st April 2021, 2001, FMV in itself includes the value built up or the property that has been built up. Any kind of improvement that has been made is already incorporated in FMV. So you are required to ignore any kind of improvement made before 1st April 2001. Did you get this point or not? Did you get this point or not? Just repeat after me what I am saying. Just repeat after me. If you are transferring any long-term capital asset, any capital gain will be computed as long-term capital gain. Any cost of acquisition has to be indexed before any transfer. How indexation will be done? Any cost of acquisition divided by the CII of the year of acquisition multiplied by CII of year of transfer. Any improvement has to be indexed, but if property is acquired before 1st April 2001, then such CII will be taken. Then CII will be taken as for previous year 101 multiplied by either it can be FMV, either it can be cost of acquisition, whichever is higher. But for removal property, FMV can never be greater than SDV. Any improvement made before 1st April 2001 has to be ignored because it is already included in FMV. Did you get this point? This was second proviso to section 48, how indexation concept works. Now we have first proviso. What first proviso says? I need your attention for a minute. I need your attention for a minute or we have Mr. Joey. Mr. Joey. He sent $1,000. He sent $1,000 to India to invest in Rahul Private Limited. He was very bullish on Rahul Private Limited, so he sent $1,000 to India to be invested in Rahul Private Limited. At that time, dollar conversion rate was rupees 100 rupees per dollar. So ultimately, he invested 1 lakh rupees to Rahul Private Limited. After too much of years of hard work, after many years of hard work, I was able to stand upon his eyes. Like I was able to fulfill his expectations, and his money grew to 1,50,000. His money grew to 1,50,000. Now government says tax, pay us taxes. Value of money, sorry, the shares of Mr. Joy increased. Value of shares of Mr. Joy increased. Now Mr. Joy is required to pay tax. Government wants to tax us transaction. How capital gain will be calculated? Capital gain will be simply calculated 1,50,000 minus cost of acquisition 1 lakh. Ultimately, 50,000 is to be paid. 50,000 is to be paid. 50,000 is to be paid now. Simply, as simple as it can be. But the issue here was when he sold such money, sold such assets, sold such uh, when he converted such rupees into that day, rupee per dollar rate was 150. How much dollar do you think he took home? How much dollar do you think he took home? Ultimately, simply 1,50,000 rupees divided by 150. Can I say he took home only $1,000? Oh my God. What can you see? What can you see? He invested $1,000 to Rahul Private Limited, and he took $1,000 again from Rahul Private Limited after so many years of hard work, after so many years of patience. Whatever he invested, he takes back the same thing. But government wants tax. Government still wants tax. Do you think is it justified on regard of Mr. Joy? Do you think it is justified? Right answer is it is not justified. Whatever appreciation in the shares Mr. Joy has seen is not on account of actual increase in the shares of Mr. Rahul. It has been compensated by increase in value of the dollar. It is being compensated by increase in dollar. It is increase in the value, rupee depreciation. Whatever appreciation shares has given to Mr. Joy, the same amount has been depreciated in currency. Indian rupee has depreciated, dollar has appreciated. In that sense, Mr. Joy has no gain on such transfer. Do you think it is correct to pay taxes? Shares of Rahul Private Limited increased, no doubt. Shares of Rahul Private Limited increased, no doubt. But value of rupees has also depreciated. There is also loss on that regard. There is loss on that regard. Now. Mr. Joy is facing loss on that regard because rupee is depreciating. So don't you think Mr. Joy should be given advantage in that sense? Right answer is yes, Mr. Joy has to be given advantage in that sense. And yes, government has introduced first proviso to section 48. If a non-resident or foreign company invests in any of the Indian securities, then they are given the advantage of this proviso. What this proviso says, any capital gain will be calculated in foreign currency. Any capital gain will be calculated in foreign currency. It says if you are calculating capital gain now, consider sales consideration. What is the sales consideration? 1,50,000 converted into foreign currency. Converted into foreign currency. That means divide by 150. $1,000 is the sales consideration. How will you convert this? You have to use average price, average buying and selling price on the date of transfer. For converting sales consideration, you have to use average buying and selling price on the date of the transfer. Less cost of acquisition. 1,000. Again converted into dollar. Now what rate you have to use here? Again the rate of buying date. Average buy sell price of buying rate. Buying date. Again price on buying date was 100. So dollar is again 100. Again we have cost of acquisition is 1,000. What capital gain calculation is made? 0. Thus Mr. Joy is not required to pay any tax here. This is what first proviso to section 48. Read along with me what provision says, what our beloved study mate says. Capital gain in case of non-resident foreign company on sale of shares debentures of Indian company which were acquired or purchased reinvested, then capital gain shall be calculated in foreign currency. Any capital gain on account of transfer of shares of Indian company will be calculated in foreign currency. To ignore any forex fluctuations. See, ultimately he is earning on account of appreciation in shares, but he is also losing on account of depreciation of rupees. He is losing on that regard, so he should be given some compensation now. So for that matter, it says every calculation will be made in foreign currency, and ultimately what capital gain is calculated, capital gain will be calculated in dollars. So we have to convert such dollar again in rupee, and he is required to pay tax on such capital gain. For conversion, what rates to be used? Cost of acquisition, average buying and selling price on the acquisition date. Full value of consideration, average buying and selling price on the date of transfer. And capital gain for capital gain you have to use buying rate. You don't have to use average, you have to use buying rate, because ultimately whatever dollar you are getting, you have to sell such dollars and you have to buy rupees. So for that matter you have to use buying rate. One thing you have to take care of is assessee should not be resident in the year of transfer. In the year of transfer, SSC should not be resident. If SSC is resident in that case, he will not be given any benefit of this proviso. And last thing, no kind of indexation is available if he is getting benefit. Ultimately, he is getting benefit of lower tax rate. He is getting benefit of foreign fluctuations. Again, you want the benefit of indexation. Right answer is you will not be benefited any kind of indexation in this regard. You will not be given benefit of indexation in this regard. Did you understand this point or not? Yes, sir, we did understand. What third proviso says? Focus should be here. First and second proviso is not applicable for computation of LTCG under section 112. What first proviso says? Forex fluctuation should be ignored. What second proviso says? Indexation. These both provisos are not applicable for shares that are listed. Any capital gain calculated on the shares which are listed, or any capital gain which falls under section 112A, does not have any impact of these first two provisos, which means if any listed shares are sold, you will not do any indexation for cost of acquisition, or you will not calculate foreign currency, you will not calculate capital gain in foreign currency. In both the cases, first and second proviso are not applicable if you are trading any kind of, if you are selling any kind of listed securities. Did you get this point or not? Also, no indexation is available for bonds and debentures except for capital index bonds and sovereign gold bonds. We'll study about sovereign gold bonds later on, but for that matter, you just understand no indexation is available for any kind of bonds and debentures. So till now, we have understood three things on which indexation is not available. We have understood three cases where indexation is not available. You can write it here or you can write it anywhere else. So first of all, indexation is not available for first proviso. Any SSC opting for first proviso to section 48, that is forex fluctuations. No indexation will be available. Second thing is for 112A securities. Any securities that are listed on recognized stock exchange, you will not get any kind of indexation on such securities. And last one is, you will not get any indexation for bonds and debentures. You will not get any indexation for bonds and debentures, but you will get indexation for capital index bonds and sovereign gold bonds. What is the concept of sovereign gold bonds? We will study later on. You need not to worry at all about it. Fifth proviso, same as first proviso, foreign exchange fluctuations in case of RDB shall be ignored in case of non-resident at the time of redemption of RDB. You can simply ignore this point, as we have calculated the first point. Again, we have to calculate here for RDBs also. Any kind of foreign exchange fluctuation, gain or loss, will be ignored while calculating the gain on RDB. Same thing as we said for first proviso. Again, this will be for RDBs also. RDB, what does RDB mean? RDB is rupee denominated bond. When you are issuing bonds to an outsider, many a times now you issue bond in dollars to allure such person, to attract them. But government incentivize companies to issue rupee denominated bonds that are denominated in rupee, so that any kind of foreign exchange fluctuations does not impact the outflow of the entity. For example, just understand this. What is RDB? See, for example, we have a company named Reliance. Reliance wants, for example, 10 CR rupees. 10 CR, it wants to raise 10 CR rupees. Now it can either raise $1,000 face value $100 bond, or it can either raise rupees 100, rupees 1,000 face value bond. It can either raise $100 face value bond, or it can either raise 1,000 rupees face value bond. These are two options available with Reliance. It can issue foreign currency denominated bond, or it can issue rupee denominated bond. Government says if you are issuing any rupee denominated bond, we do give certain benefits to the person subscribing in rupee denominated bonds. In that case, any kind of foreign exchange fluctuations at the time of redemption will be ignored. The way we did in first proviso, we have to do it here again. Okay, is that clear? I hope things are clear. Sixth proviso to section 48, FMV on the date of the allotment of the ESOP shall be considered as FVOC for the company and cost of acquisition for the employee. This is completely different proviso. I don't know why this is given here, but it is given. What it says: if an employee is allotted sweat equity shares, what will be its taxation? Just imagine, I am an employee at Relaxo. For example, I am an employee at Relaxo. Share is being traded at 5 rupees 500. I am given an option to buy 10,000 shares at rupees 100. I am given an ESOP. Correct. What gain I am getting from this? Gain will be Ultimately, on 10,000 shares, I am given 400 rupees discount per share. That means ultimately I am given gain of 40 lakh rupees gain. I am given profit of rupees 40 lakh rupees for doing my hard work. Ultimately, what ESOP is, it is a kind of salary to employee to stay in the company. It is a kind of incentive to the employee to stay in the company for such prolonged period. Already it is taxable in the head salary. It is already taxable in the salary head. You are very much aware of this fact that it is taxable in the heads of it is taxable in salary head. That means whatever 40 lakh rupees this gain, whatever 40 lakh gain is being received by me is taxable under the head salary. This 40 lakh will be taxable in the head salary. Now, when I am willing to sell this share of Relaxo, what will be my cost of acquisition? It is very simple. Now, for my cost of acquisition for me will be 500 because I've already paid tax on I am already giving 100 rupees, and also I'm paying tax on 400. So my cost of acquisition should be 500 now. My cost of acquisition should be 500. So right answer is yes, cost of acquisition will be 500. This is only this proviso says. FMV on the date of the allotment of the ESOP shall be considered as full value of consideration for the company and cost of acquisition for the employee. That means employee receiving sweat equity shares or ESOP. Cost of acquisition for such employee will be FMV on the date of allotment because already he is paying taxes on such FMV now. He is paying taxes on such FMV under the salary head. So whatever the FMV will be of that shares will be cost of acquisition for the employee. This is simple as simple as it can be. Next one is seventh proviso to section 48. What this proviso says, any kind of STT paid on purchase or sale of any shares. See, if you know, whenever you are selling any shares of listed entity, you are required to pay STT to stock exchange. If you are paying any STT, you are not required to deduct this STT from sales consideration. You are not required to deduct this STT from transfer expenses, nor you are required to add up this STT in cost of acquisition. Ultimately, you are not allowed any kind of deduction on this STT. Ultimately, this is what it says. With that, can I say we are done with provisos? Just recall all the provisos with me. First proviso is ignorance of foreign exchange fluctuations. Second is indexation. Third proviso is first and proviso not applicable in case of 112 securities. Fourth proviso, it says no indexation in case of capital index bonds and no, in any kind of bonds and debentures except for capital index bond and sovereign gold bonds. Fifth proviso says that foreign exchange fluctuations in case of RDBs should be ignored. Sixth proviso says FMV shall be cost of acquisition for employees in case of ESOP. And seventh proviso says there will be no deduction in case of STT paid for purchase and sales of any shares. Did you understand this point? Nor such STT will be allowed in case of transfer expenses. Did you understand this point or not? Yes, sir, we did understand. Now we have to understand how full value of consideration is calculated. Normally, now whatever price you are receiving for transferring such assets, for example, I sold a share for 500, so I am receiving 500 rupees. That will be my full value of consideration. But there are certain cases where such 500 rupees can be manipulated. So for that matter, government has prescribed provision has been led upon to calculate the full value of consideration. So what are the special cases? Do tell now. Simple. It is not that rocket science you are thinking. Amount received or accrued from transfer of capital asset shall be sales price. Any amount that is received from transfer of capital asset will be sales price. But there are certain special cases. For example, 50C. You have to remember this 50C because again and again I will be referring this in IFOS. What 50C says? In case of immovable property, if stamp duty value is greater than 110% of consideration, then stamp duty value shall be considered as consideration. What does that mean? For example, if a property is having guideline value or stamp duty value as, for example, 1 CR, and you are transferring it at a very lesser price. For example, you are transferring it at for 50 lakh. Government says, how can you transfer it at a lesser price? We want tax, so we will not accept your consideration. If stamp duty value is greater than 110% of consideration, then SDV will be treated as consideration. That means if stamp duty value is greater than 110% of consideration, it means that you are selling it at a very lesser price. You are selling it at a very lesser price, and we are not going to accept your consideration. We will be giving you our SDV as your consideration. We will be giving you our SDV as consideration. So in that matter, SDV will be treated as consideration. For example, if stamp duty value of a land is 11,20,000, SSC sold it at 10 lakh rupees. So can I say SDV has to be greater than 110% of consideration? 110% of consideration is 10 lakh into 1.1 is nothing but 11 lakh. SDV is 12 lakh. 11.2 lakh, sorry, 11.2 lakh. Can I say SDV is greater than 110% of consideration? Yes, SDV is greater. In that matter, since SDV is greater, SDV has to be considered as consideration. We have to ignore this 11 lakh. We have to ignore this 10 lakh. What if my house is haunted? What if my house is haunted and unnecessarily my SDV has been hyped up? What if my house is haunted? This SDV is not justifying my value of my house, because many a times house is haunted. House is scary. There are ghosts roaming in my house. So this SDV is not justified. In that case, what can I do? In that case, what can I do? Unnecessarily, I am being charged too much of capital gain. What can I do? I can ask my assessing officer to refer my case to valuation officer. In that matter, valuation officer will determine SDV for me. If valuation officer comes up with a lesser SDV, for example, actual SDV stands 1 CR. Valuation officer calculates such SDV as 75 lakh. I have an option to choose either 75 lakh or 1 CR. I can choose with any of the SDV. Of course, I will be choosing the lesser one. But in case valuation officer comes up with a higher SDV, for example, 1.5 CR. In that case, I can ignore the valuation made by the valuation officer and proceed with the earlier calculated SDV, that is 1 CR. Did you understand that if we are not satisfied with the SDV, then we can request assessing officer to refer our case to the valuation officer. If value determined by valuation officer is more than SDV determined earlier, for example, valuation officer determines 1.5 CR SDV of our house, in that case, SDV determined earlier, that means 1 CR will be considered. But in case value determined by the valuation officer is way lesser than originally calculated SDV, in that case, in case FMV or SDV calculated by valuation officer will be considered. Did you get this or not? Did you get this or not? Yes, sir, we did understand what you are trying to say. If agreement date and registration date are not same, what does that mean? What does that mean? Okay. On 1st April 2023, Rahul made an agreement with Mamta Banerjee, that I will sell house at 1 CR. At that time, SDV was 1.1 CR. Actual registry was made on 31st March 2024. Consideration was paid by Mamta Didi at rupees 1 CR, but SDV on that day was 1.25 CR. Now tell which SDV will I have to take care of. If I am considering SDV as on 1st April 2023, my SDV is not greater than 110% of consideration. Can I say it is equal to 110% of consideration, but it is not greater than 110% of consideration? So can I say SDV? Can I say SDV is correct here? But in this case, if I'm considering SDV of 31st March 2024, can I say SDV is greater than 110% of consideration? Yes, sir. In that case, SDV will be consideration as full value of consideration. Which means if I am taking SDV on the date of agreement, my sales consideration would be 1 CR. But if I am considering SDV on the date of registration, my sales consideration would be 1.25 CR. Can you understand how much difference will it create to my tax liability? Which SDV I have to take care of? The right answer is, if any amount of money is being paid by Mamta Didi to me via account pay check, account pay demand draft, or any other electronic clearing system, in that case, SDV on the date of agreement will be taken. But if any amount is not paid by account pay check, account pay demand draft, complete money is paid at the time of registry, then SDV of the date of the registry is to be taken. Did you get this point or not? Did you get this point or not? Yes, sir, we did understand what you are trying to say. This was simple case of immovable property. Then we have 50 CA. In case of unquoted shares, how we will calculate FMV? We have to find out what is the what FMV it is. How we will calculate FMV? We have to go to chartered accountant, we have to go to merchant banker. They will calculate the FMV of unlisted shares, or we have to calculate the sales price. Whichever is higher will be considered as full value of consideration. But this provision is not applicable. This provision is not applicable to the companies whose board of director is being suspended by the central government. And under Section 242 of the Companies Act, central government has powers to suspend the board of directors of the company. In case where company's board of directors has been suspended under Section 242 of Companies Act, this provision is not applicable. Whatever the sales price has been agreed upon will be considered as full value of consideration. But otherwise, sales value will be higher of FMV or sales price, or any other asset. In case of any other asset whose sales price is not determinable, for example, whose sales price is not determinable, for example, Mr. Majnu. How many of you have seen movie Welcome? How many of you have seen movie Welcome? I don't know how many of you, but there is guy called Majnu Bhai. Majnu Bhai. Majnu Bhai drew a painting of a donkey, and again there was a donkey sitting on him. This painting was not valuable. This painting was invaluable. How will Majnu Bhai determine sales price while transferring such painting? Right answer is Majnu Bhai will say FMV on the date of the transfer. Whatever the fair market price of such painting would be considered as sales consideration for such asset. Did you understand this point or not? Okay, sir, we did understand. We did understand what you are trying to say. This completes our portion of calculation of full value of consideration. Now we have to calculate cost of acquisition. What cost of acquisition implies, how it is calculated, just follow my steps. When you are buying something, whatever price you are paying, it is full value of consideration. It is cost of acquisition. For example, if I am buying a machine, if I am buying a car, whatever insurance I am paying, it will be cost of acquisition. Whatever modifications I am making, it will be part of my cost of acquisition. Everything, every expense that I'm paying to purchase that product, it will be considered as full value. It will be considered as cost of acquisition. But for listed shares, STT paid will never be a part of cost of acquisition. We have studied this earlier under 7th proviso to section 48. Also, any cost incurred for obtaining clear title of that project. For example, if my father has bought a house through housing loan, just listen to this. If my father has bought house of rupees 10 lakh rupees in previous year 1 2, out of this 10 lakh, 5 lakh he pulled up himself, and 5 lakh was loan. Now my father gifted this property to me. I have to pay this loan, and now this loan was increased to 15 lakh rupees. Can I say that I had to pay 15 lakh rupees to get a clear title of this property? Can I say I had to pay this 15 lakh rupees to get the clear title of the property? Right answer is yes. This expense is being paid to obtain a clear title to the property. So this expenditure will be a part of cost of acquisition. This expenditure will be a part of cost of acquisition. So whatever cost of acquisition I will be calculating, like this 5 lakh will be a part of cost of acquisition, and this 15 lakh rupees will be a part of cost of acquisition. In this matter, it will be added to cost of acquisition. This point, hold it for now. We'll discuss it later on. Hold it for now. Now we have to calculate special cases. What special cases? So when an asset becomes a property by the way of transaction not regarded as transfer, then what cost of acquisition we have to consider? Just imagine we have a property. I have a property. I gifted to my wife. She receives at free of cost. Now what if she transfers such property again? Are you getting? I have a property. I gifted it to my wife, and now she received it at free of cost and wants to transfer it again. Now capital gain will be leviable in her hand. What will be cost of acquisition in her hands? What will be cost of acquisition in our hands? Right answer is cost of acquisition of the previous owner. Cost of acquisition of the previous owner. For my wife, previous owner is me. So whatever cost of acquisition was for me will turn cost of acquisition for hers. And that cost of acquisition will be used for calculating capital gain. Okay, did you get this point or not? This simply means if any property is acquired out of exempt transfer, any transfer that is exempt, if I am acquiring that property out of exempt transfer, in that case, cost of acquisition of the previous owner will be considered as my cost of acquisition, and indexation shall be applied accordingly. We'll study about this later on in depth. For example, if I am doing a business, I acquire a goodwill, trademark, brand name for business and profession. Right to manufacture, produce, process any article, like we have patent or copyright. If I can either develop patent or I can acquire a patent. Right to carry on any business or profession. For example, I paid royalty or I have created a royalty, or I have some tenancy rights, loom hours, route permits, or any other intangible assets. How will you calculate the cost of acquisition of such assets? Provision simply says if they are self-generated, if any kind of patent is self-generated, if any kind of loom hours, if any kind of royalty is generated self, then cost of acquisition will be nil. But if it is purchased, if it is purchased by paying certain sum, then whatever purchase price you have paid will be cost of acquisition. And what's the most important thing, FMV will not be available. How will you calculate FMV as on 1st April 2020, 2001? Normally, all the assets, if assets are long-term capital assets, FMV as on 1st April 2001 is applicable, available. But for intangible, how will you calculate FMV? How will you know the value of patent in year 2001? There is no FMV available. So no FMV provision is available. We have, if depreciation is claimed on the assets. For example, if I have an asset for a business, then what will be cost of acquisition? The price paid minus depreciation charged till now. Depreciation charged till now will be my cost of acquisition. For example, if I had bought an asset for rupees 4 lakh, after charging depreciation for 1 year, for 2 year, for 3 year, value is turned out to be 1,82,500. And now I sell this asset for rupees 4 lakh rupees again. What will be my capital gain? Right answer is my capital gain will be 4 lakh minus 1.82 lakhs. I will not consider 4 lakh initial cost as cost of acquisition because it is a depreciable asset. For any depreciable asset being transferred later on, cost of acquisition will be after reducing depreciation. Did you get this point or not? Yes, sir, we did understand what you are trying to say. Now, bonus. If you are being allotted any bonus shares, if bonus is being allotted before 1st April 2001, then you can consider FMV as on 1st April 2001. FMV, Merchant Bankers Report, Chartered Accountants Report, if listed, then recognized stock exchange, you can consider FMV. But if shares are allotted after 1st April 2001, then value of bonus shares is nil. You have to take it as zero. You have to take it as zero. But for shares, if you remember something, for shares that are listed on recognized stock exchange, we have a concept of grandfathering, or we have a concept of FMV as on 31st January 2018. In that case, FMV as on 31st January 2018 can be taken if shares are listed on recognized stock exchange. If shares are being listed on recognized stock exchange, you can consider cost of acquisition of such shares as on 31st January 2018. How you will calculate the cost of acquisition for right shares? Company provision says whatever price you are paying to the company for acquisition of right shares. For example, share is traded at 500 rupees. You receive right to buy at 400. What will be cost of acquisition? If you buy at 400, then 400 will be cost of acquisition. If you renounce this right, then what will be capital gain? Sir, for example, I sold this right at rupees 20. So this 20 rupees will be capital gain in my hand because I am getting this 20 rupees free of cost. Ultimately, I am getting this 20 rupees on account of holding these shares. So for that matter, 20 rupees will be calculated as short-term capital gain, and this will not be having any transfer expenses for this. And for the person acquiring such shares on getting renounced, for example, I renounced it to Mr. Mayank. I had received right to buy shares at 400 rupees. I renounced it to Mr. Mayank by getting 20 rupees. So what cost of acquisition will be for Mr. Mayank? Mayank will be paying 400 to company and 20 rupees to Mr. Rahul. So what price cost of acquisition will be for Mr. Mayank? For Mr. Mayank, it will be 420. Did you get this point or not? This is how you have to calculate the value of the cost of acquisition for right shares. If rights are purchased by the SSC, cost of acquisition will be amount paid to the company. If shares are being renounced to other SSC, capital gain will be applicable. Whatever the renouncement price you are receiving will be short-term capital gain. In the hands of the purchaser, cost of acquisition will be amount paid to the company and amount paid for the right. For example, Mr. Mayank is buying these shares. What will be cost of acquisition for Mr. Mayank? Cost of acquisition for Mr. Mayank will be amount paid to company and amount paid for such right. Whatever amount he has paid to the company, he paid to company rupees 400, and he has paid 20 rupees to acquire that right. So for cost of acquisition for Mr. Mayank will be 420. As simple as it can be. What will be cost of acquisition for sweat equity shares? So sweat equity shares, cost of acquisition, we have studied in sixth proviso. Whatever the FMV on the date of the option will be cost of acquisition. As simple as it can be. For any depreciable asset, WDV of that asset, written down value after reducing depreciation will be the value of the depreciable asset. If asset is acquired before 1st April 2001, then take FMV. FMV or cost, whichever is higher, you can take. As simple as it can be. Last one, last example, but not the least example, is in case of demerger. Very simple case, very beautiful case. Just understand with me. For example, we have a company named Reliance. We have a company named Reliance. Company named Reliance. Everybody knows the company named Reliance. Take it. Now, Reliance has assets. Reliance has share price of rupees 3,000. Net assets Reliance has 1,000. Yeah. Out of this Reliance, a company is demerged named Geo Financial Services. You must be aware of this recent demerger. A company named Geo Financial Services got demerged from Reliance. How many assets are transferred? Net assets transferred are 100 CR. Out of this 1,000 CR, 100 CR has been transferred to Geo Financial Services. Can I say that 1/10 of the worth of the Reliance is being transferred to Geo Financial Services? Can I say that? Can I say that 1/10 of the worth of the Geo Financial Services Reliance is being transferred to Geo Financial Services? Yes, sir. 1/10 of the worth is transferred. Can I say price will reduce by 1/10, and whatever the 1/10 price will be the price of the Geo Financial Services? Can I say 2,700 will be price of Reliance and 300 will be price of Reliance? 20 and 300 will be price of Geo Financial Services. Did you get this point? Did you get this point? How value of demerged company we have arrived through. How we have arrived the value of demerged company. Whatever net assets are being transferred, 100 net assets are transferred out of 1,000 and share price is 3,000. Can I say 1/10 value will be the value of the Geo? Can I say 1/10 of the Reliance shares will be the value of Geo? Yes, sir. 1/10 will be the value of the Geo Financial Services. So we have arrived to the value of Geo Financial Services. And reducing 300 from 3,000, we'll get 2,700, the value of Reliance. As simple as it can be. This is how we have to calculate cost of acquisition for demerged company and cost of acquisition for resulting company. Now I'm giving you a typical case. I'm giving you a typical case. What if, what if, what if, what if, what if Geo issues 2 shares for every 1 share held in Reliance? Geo issues 2 shares for every 1 shareholder. Can I say ultimately this 300 is being divided into 2 parts? Difficult to digest, difficult to digest. I can understand. Can I say 1/10 of the worth, 1/10 of the worth, 1/10 of the worth is being taken by the Geo? Everybody agree with me? 1/10 of the worth is being 1/10 of the worth of the 1,000 CR is being taken by the Reliance Geo. And for every share, 2 shares are being issued. That means whatever the worth, whatever the value of the shares of the Geo will be for 2 shares. Can I? This simply means that share of Geo, which is 300 rupees, is worth 2 shares, which means value of shares of the Geo will be half of 300, will be 150. Did you get this point or not? Difficult to digest, but easy to process. Difficult to digest, but easy to process. Once you are processed with this provision, I am 100% sure you will never have any doubt in any of the question in such provisions. Okay. Capital gain in special cases. First of all, let us complete this. In case of demerger, cost of acquisition of the shares in demerged company. Demerged company, we have cost of acquisition of the shares held in demerged company 3,000 into net book value of assets transferred 1,000 crore out of 10,000 1,000 crore. We have 300 rupees as value of Geo. Value of Reliance will be 3,000 minus 300, 2,700. As simple as it can be. Did you get this point or not? Did you get this point or not? Yes, sir, we did understand what you are trying to say. Let's quickly move on to special cases in capital gain. Where we are now, where we are standing in this capital gain chapter. Let us first reach there. Can I say we are done with normal calculation? We are done with provisos. We are done with full value of consideration. We are done with cost of acquisition. Now we have to jump to special cases. How special cases move? Let me tell you. First part is exceptions to section 45(1). Remember section 45(1). Section 45(1) was charging section. What charging section states? Transfer of any capital asset shall be taxable under the head capital gain in the year in which transfer took place. Transfer was required to take place. Shall be taxable under the head capital gain in the year in which transfer took place. Is it possible that there might be some cases where taxability was of capital gain is deferred? Capital gain taxability is deferred. Right answer is we have 4 cases where capital gain will not be taxable in the year of transfer. Transfer takes place in another year and taxability of capital gain will be in another year. There are 4 examples. First of all is capital asset being destroyed. I had a house. I had a house. I had crafted that house out of my love. Not that because of bricks and mortars and money. I have crafted that house out of love. And one day out of civil turbulence, my house got destroyed. My house got destroyed, sir. My house was purchased on previous year, 1-2. It was purchased for 5 lakh rupees. But in previous year, 2021, out of my tears, my house got destroyed. My house got destroyed. I was having nothing. I was having nothing. But after fighting so many cases in court, I received compensation from insurance. Can I say destruction of capital asset is also a transfer? Can I say a destruction of capital asset is also a transfer? Do tell in previous year 2021, transfer took place. Can I say transfer of my house took place? Right answer is yes. Transfer of my house took place in previous year 2021. But can I say capital gain will be taxable in this year? Yeah, how capital gain can be taxable in this year? I had no money. My house is also taken. So right answer is capital gain will be taxable in the year in which compensation is received. Therefore, it is exception to section 45(1) because taxability transfer is taken in year and taxability arises in the other year. Taxability, for example, I receive compensation. I received compensation in previous year 23-24. For example, 50 lakh rupees I received. How capital gain will be calculated? Sales consideration will be 50 lakh because I am receiving compensation money 50 lakh rupees. How cost of acquisition will be calculated? Cost of acquisition will be 5 lakh. I have to index this cost of acquisition. Indexation will be done by dividing CII of the year of acquisition. CII of year of acquisition will be 100. The year of transfer you have to multiply with the CII of the year of the transfer. In which year transfer took place? Transfer took place in previous year 2021. So indexation is to be made till previous year 2021. So what is the CII of previous year 2021 is 301. So what will be index cost of acquisition? 13.05 lakh. And capital gain will arise 34.95 lakh will be capital gain in my hands. And this will be taxable in the year in which insurance is received and not in the year in which capital asset is destroyed. So just have a look. Capital gain destroyed due to fire, flood, earthquake, tsunami, riot, civil disturbance, enemy action, insurance received, then capital gain is applicable. Only capital gain is applicable when insurance is received. What if insurance is never received? No capital gain. No capital gain. It will be assumed that your house's sales consideration for the house is zero. It is assumed that sales consideration for the house is zero. You will be having capital loss. Capital asset destroyed due to fire, either by flood, either by earthquake, either by tsunami, either by riot, or either by civil disturbance or enemy action, and insurance is received, then capital gain shall be applicable. How capital gain will be applicable? Full value of consideration shall be insurance received, or if insurance is not received, money is not received, I am given a new asset. I am given a new asset, then whatever the FMV of that asset will be my full value of consideration or sales consideration. I have to reduce cost of acquisition. Indexation has to be done till the year of transfer. See, whatever cost of acquisition I have taken, I have to index that. Indexation will be done till the year of transfer and not till the year of receiving of compensation. Indexation will be done till the year of transfer. Improvement indexation will be done till the year of transfer, and LTCG, STCG will be decided till the year of destruction. For considering period of holding, only such period shall be taken from the date of buying such asset till the date of destruction of such asset. I don't have to take period of holding till the date of receiving of compensation. Only till the date of destruction of that asset will be considered for considering period of holding. All in all, if I say transfer took place in the year of destruction, but capital gain will be taxed in the year in which compensation is received. Conversion of capital asset into stock and trade. What if we do these topics tomorrow? Not an issue. We'll do these topics tomorrow. I guess this is sufficient for today. What you need to do is revise these topics. For today, I'm not giving you any question to solve, but for tomorrow, we'll be having complete capital gain to solve. Complete capital gain you have to solve from tomorrow. So, I guess the session was nice for you all. I hope you would give a big fat thumbs up to this video so that most people can get benefit from this. And believe me on, DT is doable. It is easy, it is doable. Only issue with it is lengthy. And with this power batch, we are attempting to understand it better, to do it in a lesser time, and to bring discipline within you all. With that aim, saying you a very heartfelt goodbye. Seeing you tomorrow. Have with same energy, same excitement, and same optimism. Take care and enjoy studying.